It seems like the stage is set for the Fed to have a slow decline in rates.
If you continue to see that strong growth, you could actually get that soft landing that we had been looking for.
It does seem ultimately growth is going to have to slow.
If the economy slows more than sort of a Goldilocks landing, the Fed has room to cut rates maybe a little bit more.
I do believe in Goldilocks. Productivity is higher and these trade-offs are going to continue to be the Fed's dream come true.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 slightly negative, down by 0.1%. One bank in focus since the end of January, NYCB. That stock is down 6% in the pre-market. Lisa, we're talking about cutting in half, more than cutting in half, the market cap of this bank in just about a week.
Downgraded to junk, and not just because of concerns about property, also because they can't keep their staff around. Their chief risk officer and their chief audit officer departing this month or last month. Now a question of who's going to lead this bank. Key question when you take it back, is this just a repeat of what we saw last year on every level with respect to community banks? And are we seeing the beginning of that kind of fear of contagion work its way into markets?
So with a key difference, so last year is a rate shock that we all had to work through. This year, potentially, I stress potentially, a credit shock. And it feels like a perfect storm for commercial real estate. We've been talking about it now for the best part of 12, 18 months. It's been on everybody's horizon. You've got higher rates, higher vacancy rates, and all at the same time, you've got these loans coming due as well. It's kind of like the perfect storm for this particular spot of credit.
For this particular spot of credit in this particular bank, the key question is, we were talking about a rate shock last year. People now saying, now is the rate shock, because what you actually have now are some of these loans coming due. So do you see this sort of delayed and deferred rate shock come to the fore in a more meaningful way?
And finally, we saw someone in Washington asked about this. Treasury Secretary Janet Yellen was asked about it. She says, I'm concerned. She thinks it's manageable. She didn't want to discuss an individual bank in depth, but clearly this has the eyes of individuals in Washington about potentially if this doesn't stay idiosyncratic.
So the question I'd ask, bank problem, sector problem, or market problem? Which one is it at the moment?
At the moment, it's a sector problem, because if you take a look at just the KBW index, it's down, I think, 11% just since January 29th. It's also a question with respect to specific banks that are going to that $100 billion level of assets and what kind of regulations. But if you saw, there were actually European banks that are struggling on the heels of this because of commercial real estate exposure in the United States. There's sort of the sniffing out of something that's maybe a little bit bigger, but maybe people are just looking for things to worry about.
Frankfurt, Tokyo, New York, this is becoming a global issue, Bramo.
That's the reason why I say it's unclear if it's just isolated to this particular sector. A lot of people saying it's contained. It's idiosyncratic. I know you love that word. I guess we shall see.
If you get enough idiosyncratic issues on top of one another, it's no longer idiosyncratic, right?
Right. So we have to wait to see if there are others. I will just say, today feels like deja vu all over again. I was looking at Yogi Berra quotes this morning because I was just feeling like frustrated with this sort of narrative roulette that ran out of themes, right? We're dealing with one theme after another. Banking crisis yet again. We're dealing with the issue of no landing, soft landing, who landing. We're dealing with Trump versus Biden. We're dealing with Chiefs versus 49ers. We're dealing with everything that just sort of happened in another year.
The bundle's back to the future.
Exactly. That's exactly it. We're talking about sports bundles. I mean, come on.
We're going to be talking about that a little bit later. Just to get you up to speed on NYCB, that stock is negative in the pre-market. Double-digit losses for the fourth time in 5 days yesterday. And we're down another 6 or 7% in the pre-market at the moment. The broader market is OK. Equity futures on the S&P 500 shaping up as follows. We're negative here by 0.05%. Yields are higher by a couple of basis points on a 10-year 4.1172. Coming up in just a moment, we'll catch up with Tony Dwyer of Canaccord Genuity as New York Community Bank plunges yet again. Kim Wallace of 22V Research with a border deal and aid for Ukraine set to fail on Capitol Hill. And Bloomberg's Geetha Raghunathan with a shake-up in sports streaming and Disney earnings on deck. It's back to the bundle, Bramo, back to the bundle.
I remember when we were talking with Michael Nathanson about what is the sort of new model for streaming. And he said, it's the old model. Go back to the bundle. Well, guess where we are right now.
And guess who's joining us a little bit later?
Michael Nathanson.
Michael's coming up a little bit later this morning. Look out for that. We begin with our top story today, losing more than half its market cap in just a week. New York Community Bank plunging once more after a ratings cut to junk by Moody's saying, quote, NYCB's core historical, commercial and estate lending, significant and unanticipated losses on its New York office and multifamily property could create potential confidence sensitivity. Tony Dwyer of Canaccord Genuity joins us around the table for more. Tony, good morning to you.
Good morning, good morning.
Good morning, sir. It's good to see you, buddy, in person. Let's get straight into it. Do we have a single bank problem? Do we have a sector issue? Or do we have a market problem too?
It's all of the three, but it's just not catastrophic. I think after the great financial crisis, John, everybody's waiting for that one thing in the financial sector that's going to blow up the system and create that kind of ultimate whoosh that we're going to get that creates the low that's identifiable. And this whole commercial real estate thing, it's not levered and owned by the same place that it was during the great financial crisis. So it's all three to a lesser degree, which is why we're talking in the green room. We kind of still have the zombie. We have the zombie economy. You have a Fed rate hike that has absolutely, it's been the fastest rate hike cycle in history into a generationally levered system. That's not great, but you have a service sector that's still spending money. And so you don't know if you're going to go into recession until you actually go into recession, or the Fed cuts rates and it's game on. We're just going to be in this period of uncertainty, and that showed up in the stock market.
Let's talk about the zombie, because what we're talking about is, are we seeing rate shocks that are really going to bear through in commercial real estate? Why haven't we seen more rate shocks, given that we kind of should have, given all the prognostication, the fact that companies borrowed at such low rates?
Okay, let's talk about the Dwyer family, right? So I have a 7-year, 7-1 adjustable rate mortgage. It's a 2 7/8 mortgage. Doesn't really affect me until I have to reset it. Like, higher rates don't affect me. I've already gotten the mortgage. It's not going to change for the next few years. But if I had to reset that, had I gotten it 3 years before and it's going into reset, then it's got a major change in my monthly payment. So the consumer spends on how much money they have available to them. And what kills the zombie, Lisa, this is, we got to understand what kills a zombie. Any good zombie, you got to love a good zombie movie. World War Z, Scooby-Doo and the zombie apocalypse. You got to love a good zombie, right?
Okay.
Right? So,
carry on.
So what kills the zombie is you got to figure out what created it. And what created it in this situation is a historically fast rate hike cycle. They went 75 basis points at a clip, 4 meetings in a row. So here's what they're going to do. As inflation's coming down at the same pace that it went up now, they're going to do 25 basis points and wait and see what happens. That's not the way it works historically. Once they cut. It takes longer, but then they cut faster. What kills the zombie is you kill what created it, that fastest rate hike cycle in history.
So what are you doing with this? I mean, how do you deal with zombies that aren't dying and that kind of are haunting out there, but in the meantime, things are kind of rallying and big tech is kind of leading and people are trying to rotate for a hot second?
So our view coming into the year was it was opposite day. The stage was set for a rally on October 27th, where you had this ramp. You had a historically oversold condition. Everybody was bearish. Russell 2000 was making a cycle low. The average stock was down 33%, blah, blah, blah. Right? Coming into the year, we were an opposite day. Bond yields were looking like they were going to collapse down to 3%. Everybody was at 3 3/4 on the 10-year yield. 7 rate cuts were priced in the market. It was the opposite of October 27th. I think the problem that we have in the market in this zombie-like economic environment where it's not discernible is you're chasing your tail. So you chase a ramp. Okay, it's good. We're good. And then it tanks, and you're like, all right, we're going to zero. And at the end of the day, over the last 2 years, cash has been the greatest performer. Because outside of the S&P 500, driven by those top 10, the Russell's down still 20% from peak. The equal-weighted S&P 500 is down over the last 2 years, slightly. So cash, you don't need to make a big call. We love big calls. Come on, TV, I'm going to make a big call. I don't need to make a big call. The big call is have some kind of medicine for the economy and for commercial real estate, for everything, for the government, for the election. You need lower rates.
Make a big call, Tony. Tony, it's funny you say this because back in October, we talked about this. You've got yields of 5% on a 10-year, through 5% on a 2-year. No one wants it. You drop down to 4, pile in, let's go. And now we've got this reversal once again. I think what we're trying to work out from the equity market perspective is whether we can continue to see a rally built on fewer and fewer names. We've gone from Mag 7 to what now, Lisa? Mag 4?
Mag 4.
Mag 3, Mag 2, who knows, by the end of the week.
NVIDIA.
Tony, do you expect this market to broaden out anytime soon?
Well, so our call, as you know, in 2022 is be pretty defensive. Even in 2023, you're going to get the rallies. I think we did a good job of calling them. I'm waiting for, now that you've got the Fed has made a pivot. The Fed is not saying we're going to look to raise rates. The Fed has said we're looking to lower rates. The timing of it's unclear, but that Fed pivot is an important thing. To me, what that makes me want to do is buy into that kind of weakness we saw on October 27th or any other low that we've had during that period. So that's where I'm different. In the last 2 years, I kind of wanted to rent stocks when they went down. You know, you get this whoosh, you want to come in, sentiment's too negative, and you get a nice bounce. Now I want to own them when they go down because I've had that Fed pivot. You've had an inflection point in leading economic indicators and money supply off of historically weak levels. So you have that kind of framework. Here's the problem.
Sure.
Let's look at the S&P 500. I don't do, targets are kind of made for TV. So let's use a consensus target of 5,100.
No calls, no targets. What are you doing?
I got right. Coming on TV, having fun with you guys. Print. Good morning. Good morning. So
You're crushing it, Tony.
So 5,100 is the consensus target, right? That's a pretty small increase from here. It's well below the 6-month or 1-year T-bill. So that's, John, the call, and I'd like to make good calls. Opposite day in the beginning of the year when everybody wants to chase stocks, fade it. That was our call. October 27th, stage is set for a rally when everybody's, selling them and the Russell's tanking. There's calls to be made, but you don't do it until the indicators, both macroeconomic and tactical indicators, get you to the right place. And they're in no man's land right now.
Tony, this is great. You're going to stick with us. Tony Dwyer there of Canaccord Genuity. I'm not sure what it is about cartoons and fairy tales. We put Goldilocks on life support yesterday. We're talking about Scooby-Doo this morning. We're trying to broaden the audience here.
We're trying to
make Lisa laugh.
We're trying to reach a younger cohort. I can say, though, that the feeling of frustration and turning to cartoons highlights this feeling that we've been here before, maybe in a younger year, and are just trying to sort of, embody the frustration that a lot of people feel.
Executive producer writes in, do we need to bill Tony for the use of John's trademark after the hit? I mean, maybe. Equity futures on the S&P negative here by 0.06%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. PIMCO says the Bank of Japan may scrap its negative interest rate policy as soon as March and hike multiple times this year. The firm predicts that the BOJ will raise its benchmark to 0% in March or April before hiking by a quarter point by year end. PIMCO says quickening wage growth will likely create persistent inflation, allowing the central bank to exit negative rates. House Republicans are vowing to bring articles of impeachment for Homeland Secretary Alejandro Mayorkas back to the floor. The initial vote failed 214 to 216 after 4 GOP members sided with Democrats. But the Republican majority expects to hold another vote once House Majority Leader Steve Scalise returns from cancer treatments. Republicans charge Mayorkas with refusal to enforce immigration laws and failing to secure the border. Online talk show host Tucker Carlson says he will soon interview Russian President Vladimir Putin. The former Fox News anchor had been spotted in Moscow in recent days. The interview would be Putin's first conversation with Western media since the beginning of the Russian invasion of Ukraine. Carlson says he also intends to interview Ukrainian President Vladimir Zelensky. That's your Bloomberg brief. John.
Danny, thank you. Just to take a moment on that story, AMH, I'm not sure we can cover that story without pointing out the criticism of Tucker Carlson of traditional media. And he failed to acknowledge that there are journalists in that country who have tried to cover this conflict who are now in prison. Plenty of organizations around the world have reached out for an interview with President Putin. They just haven't been given one.
Right. And Tucker Carlson, in this video, he taped in Moscow before he sat down with President Putin, which, by the way, we should note, the Kremlin confirms that Tucker Carlson and Putin did, in fact, sit down and Putin gave him this interview. He said that no other Western media bothered to interview Putin. 2 U.S. journalists, one from Radio Europe and Evan Gershkovich of Wall Street Journal, are detained and in prison in Russia, trying to cover that side of the story.
Any more headlines from that, of course, we'll bring them to you. Up next on this program, the Senate's border deal dead on arrival.
We can't walk away now. That's what Putin's betting on. Supporting this bill is standing up to Putin. Opposing this bill is playing into his hands.
That conversation is coming up next, live from New York City this morning. You're watching Bloomberg TV. Live from New York City, equities a little bit softer on the S&P 500. We're down here by 0.06%. 0.06%. Yields are higher by a single basis point, 4.1153 on a 10-year. Under surveillance this morning, the Senate's border deal dead on arrival.
All indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. He'd rather weaponize this issue than actually solve it. We can't walk away now. That's what Putin's betting on. Supporting this bill is standing up to Putin. Opposing this bill is playing into his hands.
Here's the latest this morning. The president pinning the blame directly on Donald Trump for tanking the Senate's deal to secure the southern border and provide aid to Ukraine. Kim Wallace of 22V Research remaining optimistic that something can still get done, writing this. A high conviction call remains that both Israel and Ukraine receive U.S. assistance this quarter, possibly as early as this month. The fate of the less market-relevant border agreement may not survive in any form, but it's too early to know. Kim, let's get straight into it, sir. Been looking forward to this conversation all morning. So before, it was Republicans who wanted to attach a border agreement to aid for Ukraine and to Israel, and now we're talking about unbundling that and still getting the aid done. Is that right?
That's certainly a possibility. One thing we can't know is what's going to happen next on the House floor and in negotiations between the House and the Senate. That's been proven steadily the last year. My point is, it's now that the border deal has been jettisoned by the people who asked for it, the next pertinent question is, does that mean the linkage between a border policy and Ukraine aid is no longer viable? Or, different way to ask the same question, does Ukraine aid die in the House along with border policy? My guess is no.
Well, a lot of Republican senators, to John's point, were linking this, and they said they will not sign up for Ukraine aid until the border is fixed, not just the border fixed, but parole, asylum provision changes. So do they need to still work on the border before they even begin discussing aid to Ukraine?
I'm not sure, because reading the bill, and I don't know how many members of Congress have actually read the Langford-Murphy-Sinema agreement. It's extraordinarily detailed. It is comprehensive. I won't compare it to what was done under Reagan, but certainly it approximates what Ted Kennedy was attempting to negotiate 30 years ago. Everything that's been asked for, and we do, let's face it, we have a beyond decrepit and broken immigration system, not just in the southern border, but period. But everything that's been asked for, more enforcement agents, more money for judges to move through asylum applications and decide on refugees. All of that is in the bill, along with a reform of immigration from the top to the bottom. It's an expansive bill. I would think that you'd keep that language in the drawer. If it's not viable in 2024, keep it in the drawer and see if it can come back in 2025. But the real question, and of course the market relevant question, is what happens to the war assistance aid, not just for the countries Israel and Ukraine, but also for the request for defense industrial-based investments and other things that apply to the U.S. directly.
Well, let's go to some of the war aid. Yesterday in the House, there was no agreement on a clean Israel bill. You have hawks, fiscal hawks, saying it's not paid for. You have progressives who don't want to vote for it, especially because it's no strings attached. How does Israel aid get done without being paid for in the House, and at the same time making sure Democrats can vote for it when Biden said he's going to veto a clean bill?
You know, I don't mean to, certainly this is not jocularity on display, but we have a pattern that's been established the last 13 months at least in the House of Representatives and in the Senate for that matter. Each body needs to pass legislation that they can pass. And then you find out what the negotiation can become. It's sort of a public discovery process as opposed to one that's usually negotiated in private. I am of the mind strongly, if you go back to the debt deal in May, that was dead 3 or 4 times within a week before it was alive and passed quickly. It's hard to predict what the next turn in negotiations are in Congress, largely because, as we saw last night, it's very difficult to count votes in the House. And in the Senate, they are more than likely going to send the House war supplemental aid with both bills, or both countries covered, and find out what happens. That's certainly one path, but I wouldn't preclude the numerous paths. I would focus more on the outcome. And the outcome for most members, their incentives are to provide aid to Israel and Ukraine. How they get there will be interesting to watch.
Well, the headline in the New York Times was a day of dysfunction. When you take a look at the Wall Street Journal, it's talking about how people have less confidence in the longer-term economic outlook simply because there is a feeling of things not getting done. And then Jay Powell on Sunday in the 60 Minutes interview talked about how in the long run, the U.S. is on an unsustainable fiscal path, and that just means the debt is growing faster than the economy. It's probably time or past time to get back to an adult conversation among elected officials about getting the federal government back on a sustainable fiscal path. Are there any adult conversations, Kim, happening right now?
Yes, several of them. They just don't surface because they don't win the day and they don't drive headlines. But Chair Powell's point, and a lot of people's point, is that fiscal risk is coming. It's looming on the horizon. Washington hopes that it can ignore it for another 3 or 4 quarters so they get beyond the election. But this is the year that we pass, according to CBO's projections, and they update their projections today at 2 p.m. It's the first economic and budget outlook from them for 2024. They have said beginning this year, net interest payments will exceed the primary deficit as part of the total deficit. So we will be paying bondholders more than we are paying for programs, all of it with deficit spending. Amazing. That's not sustainable. I don't know how long it can go on, but you have to be concerned about issues like Treasury issuance, appetite for that issuance, and official liquidity. All of these discussions are adult and they're going on in the background. Maybe not on Capitol Hill yet.
Hey, Kim, this was great. It's good to hear from you, sir. Let's do this again soon. Kim Wallace there of 22V Research. Lisa, run on time. $42 billion of 10-year notes coming today. Tomorrow, I believe, $25 billion of 30-year bonds.
It's going to be a record issuance of 10-year notes today. And this really goes to Kim's point, which is we are paying for interest payments with new debt payments. This is like a classic PIK toggle bond in high-yield bond land, which is basically the most risky thing you could possibly do, where you basically defer all of your debt interest and you borrow more to pay for it. Those bonds are not treated kindly in the market, yet U.S. Treasuries have not yet woken up to that.
Tony, let's talk about this. What is happening in the fixed income market? I remember a few months ago we were worried about the deficit. Now we're comfortable again. How worried are you?
So you cannot fix debt with exponentially more debt. The issue with that, John, that's been the case since 1987 when I got into the market. Like, this is stuff that strategists and macroeconomists have been talking about since the early 1980s. Let me give you a little perspective in that. One of the things that really got us more cautious in 2022 was the moment that Jerome Powell used the name Paul Volcker. Because when you look at when Paul Volcker inverted the yield curve and shut down credit, which has been the case ex-private credit and private equity, but when he did that in the early 1980s, you were at a generational low in debt to GDP. We're at a generational high in debt to GDP. In 1982, government debt to GDP was something like, I think it was 46% or something like that. Now it's 131%. So when Paul Volcker did it, and it had the impact that it had, that was catastrophic to the economy, we did it again with more debt, but it hasn't mattered because there's another source of capital, and that's private credit.
And we can get into that in just a bit.
Sure.
Do you care about the auctions, though?
The auction stuff, it was a great shock when Janet Yellen announced, former Fed official, now working for the Democratic institution, said that they were going to lower the amount of long-duration maturities when the market was worried about that. That was so surprising. So, yes, I'm worried about it when it's being priced in right now. The bond market has been up on a ramp. So going into it, the market's already worried about it. At least this goes into the whole thing. Is like, how's the market going to react to an event isn't dependent on the event. It's dependent upon how it reacts going into the event. So think about, all of the times that we've had these major surprise moves, it's because it's already been discounted. It's already been priced in largely. It's never universally discounted. And we've had a ramp in Treasury yields, so some of that is already priced in.
Tony, it's good to see you.
Great to be with you.
We should do this every week. This is great. Tony Dwyer.
Well, there's a price to be paid.
Canaccord Genuity. Got to tell me how much. Equity futures on the S&P, just about unchanged. Coming up next, going back to the bundle. Disney, Fox, Warner Brothers crafting their own sports streaming service. That's next. This is Bloomberg. The S&P 500 looks like this right now. Equity futures are slightly negative, with the emphasis on slightly. We're down 0.01%. The Nasdaq's doing okay, at 0.1%. Once again, the Russell, the small caps underperforming. We're down 0.5%. Yesterday, okay session for the small caps, but rock bottom. Underperforming sector. Once again, the financials on the Russell. Looks like the bank's in the penalty box, Bramo, all over again.
Given the fact that you've seen the KBW index of regional bank stocks completely tank, you do wonder how much people are treating this as idiosyncratic with respect to New York Community Bank and how much people are extrapolating out to maybe another repeat of last year.
We'll get into that I word in just a moment, shall we? Let's get to the bond market and let's talk about the S word, supply. The 2-year, the 10-year yields are just a little bit higher by a basis point on a 10-year, 4.1153. Let's call it unchanged on a 2-year at 4.40. I'll go over the numbers again, and Lisa can talk about the significance of this and give you some scope. 42 billion of 10-year notes today. Tomorrow, 25 billion of 30-year bonds. Lisa, that's a lot of supply.
Yesterday, there was a 3-year bond auction that went okay. It actually went pretty well. The question is, as you get longer duration, how much do people get worried about the sustainability of the debt path that the U.S. has? How much do people start to bake in that premium? How worried are people about resurgent inflation and no landing, soft landing, who knows landing kind of economy? But there's this issue here. As we deal with this, when do the auctions become important? When they have some kind of hiccup. Otherwise, people ignore them.
When yields get closer to 5%.
Maybe.
Maybe.
Or just any kind of disruption that sort of suggests that can give people some room to run with that kind of narrative.
Let's get into foreign exchange. The euro finding some stability just yesterday after the biggest 2-day drop going back to September, I think, over the previous 2 days before yesterday. The euro right now, 107.68, positive by 0.1%. This tension around the ECB. Lisa, you look at the data coming out of the United States at the moment, strong. You listen to the guidance from the Federal Reserve pushing back. It's very, very difficult to say the Fed's going to go before the ECB based on the data in the United States versus the data over in Europe.
You're feeling that, really. I actually think the euro-dollar is actually quite interesting right now because it's just grinding weaker with the euro underperforming the dollar, and people are saying maybe it has longer to run. Isabel Schnabel in the FT trying to push back a little bit, saying, wait a second, last mile is going to be tough, and nobody really believes her.
Jane Foley of Rabobank coming up a little bit later this morning. Just this idea that maybe the euro can drift back towards parity. We'll get her forecast a little bit later. Under surveillance this morning, our top story, one of them at least, House Speaker Mike Johnson suffering back-to-back defeats. House Republicans failing to impeach Homeland Security Secretary Alejandro Mayorkas yesterday by a vote of 214 to 216. Just moments later, a bill providing aid to Israel without additional funding for Ukraine also failed in the House. Speaker Johnson threatening to bring back articles of impeachment against Secretary Mayorkas when the votes are ready in the coming days. Annmarie, it feels like McCarthy on repeat down in Washington, D.C.
Oh, certainly. The pressure is rising for Speaker Johnson. This is what Punchbowl News put out this morning. Quote, "It is truly one of the most embarrassing days in recent House GOP history." Think about how embarrassing the last few months have been for this House caucus of Republicans. And Punchbowl is saying this is one of the most embarrassing back-to-back defeats. Why did you put the clean Israel bill on the floor if you knew it was going to be shut down? Why did you put my impeachment of Mayorkas on the floor if you knew you didn't have the votes? They knew that a few Republicans were going to join Democrats and shut it down. This is something that you promised your base you were going to do. And then you have back-to-back defeats. What are you offering to the Senate to try to get some sort of agreement?
Your own question. Why? Why did they?
I think they thought potentially they had a little bit of wiggle room with some people not being present. But you did have a Democrat who was at the doctor who then made it back to vote on this. But it just means that they're not whipping correctly. So something seems to be off, with the structure of how they're operating. But back-to-back defeats, it is embarrassing, per Punchbowl's words.
Well, for me, I'm just wondering, how do you get beyond just being a party of no? Mayorkas impeachment, no. Border bill with some of Ukraine aid, no. Standalone Israel bill, no. Nikki Haley lost to none of these above. Options in Nevada. I mean, really, like how many no's can we get in one day?
Isn't the current sitting president campaigning on a big no? Basically saying Donald Trump no? Isn't that ultimately the campaign of the current Democratic president this campaign season?
And in fairness, the campaign from former President Trump is no as well. So you have no, and no wonder people don't feel particularly confident.
Not much of a vision at all, is it?
Exactly.
No. Should we move on? Maybe we should. Let's talk about financials. New York Community Bank losing more than half of its market cap in about a week. The stock falling to the lowest level since 1997. And Moody's cutting its credit to junk. The agency warning of NYCB's holdings in commercial real estate. NYCB's CEO defending the bank after the downgrade and pledging to bring in a new chief risk officer and chief audit executive. When you have to do that, Lisa, you know you're in a tough spot. They're in a tough spot.
Which is the reason why you're seeing the shares fall commensurately. The I word is really what we have to talk about. How idiosyncratic is this? How much is this hinged on two properties that are defaulting? How much is this starting to broaden out, given the fact that we're seeing in Germany, for example, some lenders deal with U.S. commercial real estate issues. You're seeing that in Japan. You're seeing that with other potential firms in the U.S. When do we see it kind of, the zombies, to use Tony Dwyer's analogy, when do we see the zombies actually come to the fore and bite versus just kind of lurk out there?
What's unsettling, I think, about NYCB is that it was just two loans. And I'm not saying it's just two loans, but the big part of that story in the last week or so was just two loans. The idiosyncratic work is interesting, so let's work with that. You've got higher rates. That is not idiosyncratic. A lot of people have got to work with that. The commercial real estate thing, I don't think we can say it's idiosyncratic for a couple of lenders. Everybody's got to deal with that. Vacancy rates are down. We're seeing these loans mature this year, a lot of them all at the same time. That's problematic. Where there is a unique aspect to the NYCB story is just operating in certain markets where you can't put up rents in the way that you'd like them to. I think that is slightly unique to some lenders in certain markets. But the overall story, higher rates, lower vacancy rates, all of these deals coming due at the same time, I don't think that's that idiosyncratic. I think that's a big theme for 2024.
You throw in the regulatory overhang and the potential to have to increase withholdings if you cross a certain level. Once again, that also is a pressure that's facing some other banks as well.
More on that coming a little bit later. Let's turn to this story. Sports streamers are going back to the bundle. Disney's ESPN, Fox and Warner Brothers are joining forces to launch a sports streaming service to show games usually seen on traditional TV. Each company will own 1/3 of the new venture. A name and pricing have yet to be announced, but it's expected to launch by the fall. Geetha Ranganathan, Bloomberg Intelligence media analyst, joins us now. Geetha, let's get straight into it. What is driving this story?
So I think a lot of different things, John. I mean, we know that Disney has been talking about taking ESPN over the top. They, of course, have, the marquee sports packages and, of course, the flagship ESPN network, which houses some of the best properties when it comes to sports. But really what all of these media companies are facing is, number one, is cord cutting, which is more and more people are leaving the traditional pay TV bundle. We had over 100 million households paying for it about, 8-10 years ago. Right now, that number is 70 million. So 30% of that base has been eroded, and it's probably going to erode and erode much, much faster. And so these companies obviously have to make that pivot and do it soon. And I think more importantly is also the question of costs for them, because if you look at what all of these big media companies are paying, it's about $30 billion that they pay the sports leagues every year in terms of rights fees. I mean, just Disney, Fox, and Warner Brothers Discovery are paying close to about $20 billion or so. So this really kind of helps them pool their resources, and it definitely helps them bid more aggressively for rights that kind of come up rather than against each other.
So, Geetha, this is a really important point. I just wonder what this means. If you're the NBA, the NFL, and you're looking at the sports auctions over the next several years, are you disappointed with this? Does this mean you're going to get less money?
Maybe. I mean, obviously having more bidders in the market definitely works to the benefit of the leagues. But having said that, we also have many new entrants in the sports bidding market. I would give you the example of Netflix, which just recently bought, WWE for $5 billion. You obviously have Amazon and Apple, which have kind of entered the market in a huge way over the past few years also. So we do have big tech. Of course, you have Google with, NFL Sunday Ticket. So we do have a lot of the big tech players kind of bidding very aggressively. So it's a little bit of both, I would say, John.
How close are we, Geetha, to actually going back to a bundle? And then you can basically pay either a separate amount just to get that, or you can get it through both Disney or for potentially Netflix, right? I mean, how far are we from basically going back to where we were before the streaming?
Yeah, it's funny, Lisa. I mean, we've come back full circle, right? So what Disney is doing is they know, Disney, Fox, Warner Brothers, they all know that they have an edge against Netflix because they really own the sports part of the whole media equation. I mean, Netflix is kind of now dominating when it comes to entertainment content, and that's fine. But Disney, Fox, Warner Brothers, they're trying to capitalize on what they have, and stem losses and make the most of it. So obviously, I think what we're going to see in a new world is kind of this bifurcation, right? You're going to see a sports bundle and you're going to see an entertainment bundle. Disney obviously is also bundling, this new sports package with its own Hulu and Disney Plus. So I think, that's going to actually help them overall in terms of, selling the entire package. But I think pretty much we're going to see the sports bundle and maybe Netflix and another service.
Moffitt Nathanson calls it the skinny sports bundle we've been waiting for. Is there enough content on this to attract all these consumers?
I think it definitely has enough content. Does it have everything? No, it doesn't. We're missing, Paramount, which has some of the key NFL packages, which has, March Madness. We're also missing, NBC and Peacock, and that, they obviously have some of the NFL packages as well as the Olympics. So it doesn't necessarily have everything, but I think it's definitely a good first start, and it helps the hardcore sports fan kind of get quite a good array of sports content.
Geetha, I'm thinking out loud, which is always dangerous, but bear with me. I'm thinking back to Hulu, which originally was a joint venture between several organisations and now ultimately is something just owned by the Walt Disney Company. Geetha, there was always this question mark about the future of ESPN. As you start to come together with other sports TV providers, could this be an option further down the road for ultimately the Walt Disney Company to spin off ESPN and just be consumed by this new joint venture run by two other companies?
Yeah, I definitely think so, John. I mean, that's a really interesting point. It's been kind of brought up over the years many, many times. Definitely possible. I mean, I think what they're going to do eventually is, of course, they have ESPN Plus, which is, kind of their skinny streaming service with some of the second-tier sports. That has about 26 million subscribers right now. But I think eventually ESPN Plus will probably be shuttered. Everything will kind of move onto this new streaming platform. And who knows? Yeah, probably, maybe the leagues can take a stake in it. Maybe it will be spun off and managed as a separate entity. But definitely it lays the groundwork for a lot more things to come.
Interesting. Any ideas about pricing, Geetha, this fall? Any numbers out there?
Not yet. I mean, we knew that the ESPN skinny service only with ESPN content would have to be priced at least $20 just for kind of it to be equivalent to the linear TV bundle. So I think this has to definitely come in at, maybe well below $100, definitely, which is the cable bundle. But obviously somewhere, I think the sweet spot would be somewhere in that $40, $50 range, maybe.
Interesting. Geetha, thanks for the update. Appreciate it. Geetha Raghunathan there of Bloomberg Intelligence. Bramo, thoughts on this one? $40 a month?
I just imagine that they're going to bundle things together and then they're going to sell it back to you at 5 times the price that the original bundle was at. I mean, essentially, isn't that what's going to end up happening? You could get exactly what you used to have just for, $437 a month.
So Hulu's already super, super expensive, right? It's like kind of nuts now. I think our producer just said subscription fatigue. Subscription fatigue is a real thing.
Right. So at some point, you might have subscription fatigue in terms of the number of subscriptions. Just a question here, though, of the price and whether people will say, fine, as long as I don't have to search 10 different platforms for my soccer game on a Saturday, I'm okay paying a higher price.
But still, some analysts are calling it skinny. And what we heard from Geetha is that there's some NFL games, if you watch American football, there's some NFL games that you have to go then to another subscription for. I mean, isn't the whole point of the bundle? Isn't the whole point of the bundle to one-stop shop? But it's not.
I play this game every weekend. It's like, where's the game? I mean, you're living it at home as well. It's like, what is the game on? Is it on Peacock or can I just watch this?
Which is the reason why I ask, how much are you willing to pay to not have to play that game?
I'm one of those idiots that will keep on paying. We just love sport that much.
That's my point.
Keep on paying.
That's where they're going to get the money.
I know.
It's going to get expensive.
Like
from idiots like me. Equity futures on the S&P totally unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump has been denied immunity in the case surrounding his efforts to overturn the 2020 election. He attempted to claim that a sitting or former president is immune from criminal charges. The ruling was unanimous from a Washington, D.C. federal appeals court and now moves Trump closer to the possibility of facing a trial ahead of his November's election. The Republican frontrunner has until Feb 12th to appeal the ruling to the Supreme Court. Shares of Snap plunging in the pre-market trade. It was a disappointing revenue from its holiday quarter. Fourth quarter revenue comes in $1.36 billion. That missed the analyst projections of $1.38 billion. The parent company of Snapchat has been restructuring over the past 2 years and recently announced that they're going to cut the workforce by another 10%. Taylor Swift kicks off the Asia leg of her tour in Tokyo today. Spending on tickets, hotels, and other related activities is estimated to reach $230 million. That's according to a lecturer at Tokyo City University. Swift performs in Japan through Saturday, after which she's expected to fly to Vegas to watch her boyfriend and Chiefs tight end Travis Kelce play in the Super Bowl. That's your Bloomberg brief, John.
Danny, thank you. It took the BOJ 20 years of zero rates and building up a massive balance sheet, and all they needed to do was organise a tour of Taylor Swift in Tokyo.
And also Lionel Messi, although that I guess is
to get
controversial
inflation
at this point.
up.
Exactly. They're doing a good job.
Super straightforward. Up next on this programme, the Fed in no rush.
The last 3 to 6 months has been surprisingly good news. Again, I don't want to say we're done yet. I don't want to say we're necessarily going to just glide past all the way to 2%.
That conversation's up next, live from New York City. This is Bloomberg Surveillance. Live from New York City, equity futures doing okay, just about unchanged on the S&P 500. Lots of supply coming up over the next 24 hours. 10-year supply today, 30-year supply tomorrow. Yields just a little bit higher, up by 2 basis points, 4.1211 on a 10-year. Under surveillance this morning, the Fed in no rush.
The last 3 to 6 months has been surprisingly good news. Again, I don't want to say we're done yet. I don't want to say we're necessarily going to just glide past all the way to 2%. But fingers crossed, the data is looking positive.
Here's the latest this morning. Fed officials cautioning against easing too soon. Cleveland Fed President Loretta Mester adding the Fed should look to gain more confidence in order to cut later this year. Jane Foley of Rabobank writing, quote, "The House view is that the Fed is unlikely to start cutting rates before June. We expect dollar strength to moderate in the second half of the year as the Fed's rate-cutting cycle kicks off." Jane Foley, I'm pleased to say, joins us now for more. So, Jane, that's the longer-term view for the second half of the year. Let's deal with the near-term right now. You've got a 3-month price target on euro-dollar of 1.05. My initial question is, why is it 1.05 and not lower, given the recent data we've seen?
Well, that's right. You know, that number's been in there for a while, and that certainly seemed more brave, perhaps, at the end of last year when the consensus appeared to believe that the dollar was going to soften. The dollar has, of course, strengthened this year. A little bit lumpy journey, but certainly that's been the direction. And, of course, the reasoning for that is that the market has been pushing back, perhaps reluctantly, but pushing back on or anticipating that the Fed will cut less than the market had hoped for. So we think that's got further to go. I mean, we've seen it in the comments that you've just read out from 2 of the Fed officials. From a credibility point of view, you know, why would a central banker that's worked so hard to get rid of inflation sort of give up in the last mile and risk their credibility, risk the credibility of the central bank by allowing inflation potentially to rise again when the job's just not quite done yet?
Jane, that's very true for the Federal Reserve, but it's also true of the ECB. ECB's Isabel Schnabel trying to hold up the helm of some of the hawks, saying today in the Financial Times, recent incoming data do not allay my concerns that the last mile may be the most difficult one. Once we start to cut rates, and as I said, we are not there yet. We must proceed cautiously in small steps, may even need to pause on the way down. Jane, do you believe this? Do you actually take her on her word, or do you think that this is just jawboning?
No, you know, I think there is value in what she's saying. And I think very specifically with the ECB, they're looking at wage inflation. So the labour market in Europe is tight. This is a demographic issue. We've got it across all of the OECD. And they're watching that wage inflation. If that wage inflation begins to loosen, well, certainly that they could cut, you know, in perhaps June, but perhaps not earlier than that. But I think a very interesting perspective for the ECB, given the weakness of the German economy, is what do they do then? You know, what is going to be the pace of their interest rate cutting cycle maybe into 2025? Because certainly if you look at the data that's coming out of Germany, again, very weak industrial data this morning, you know, that there is, I think, a really good argument to say that euro-dollar needs to be sort of soft over the next 24 months to allow Germany to recover. And by soft, I mean, I think there's a far greater chance of euro-dollar being, say, 104, 112 in the next 24 months and sort of 115 and above. I think the Eurozone economy needs it, and the strength of the US economy could justify that.
Does that give the ECB more cover to actually go first and go further than the United States just because of that weakness? And I'm talking about rate cuts.
Well, again, the data has to be there. So it is all very much dependent on that wage data, I think, from Europe. If that is softer, yes, they can cut a little bit sooner. If it is not, I think they'll wait. But it does raise questions about how fast they might be cutting into 2025. And that could produce, quite an interesting dynamic.
Jane, it's not just European weakness that we need to talk about with regards to the euro. It's China too. China really struggling. And I think we're all struggling to get clarity on a policy extent, the policy moves, the policy effort coming out of China at the moment. Jane, where are we going in China? We see story after story, report after report that Xi Jinping is about to do something to support the market, support the economy, and little evidence of it. Jane, what are you looking for?
Again, I think we must all realize that perhaps we're looking at China from the perspective that we look at the US economy or the European economy or the Japanese economy, where stimulating consumption is where governments tend to go. That's not necessarily the story of China, of the government that we have there. It is more about trying to boost exports and not consumption. So we must re-educate ourselves with respect to that. I think that accounts for some of the impatience that we have, because we don't perhaps understand the different psychology in China. But, this does affect so many other countries. China is the biggest consumer of commodities. It's a big export partner to Germany. And this definitely comes back to German weakness through that trade channel. If you look at factory orders, for instance, they appear to be strong yesterday in Germany. But actually, if you remove aircraft, for instance, you still see a lot of weakness in the auto sector and other parts of the machinery production sector. So the weakness of China is coming back in various different channels.
A dollar China with a 7 handle used to mean something, Jane. That's where we are right now, and seemingly people more comfortable with that. Jane, what are you expecting to develop on the currency side of things?
Well, from our point of view, I think this will more dollar strength, and I think that is going to be a story that's going to carry on, like I say, until the Fed does start to cut interest rates. And at that point, there may be a little bit more interest in maybe EM, for instance, a little bit more interest in high yield. But of course, that very much depends on the broader outlook of the global economy. And China is part of that as well. But for now, I think the Chinese renminbi is on the back foot.
One thing that I try to do every morning as I read different headlines is try to parse the signal from the noise and what actually matters. And one thing that I hear increasingly in the noise are central bankers talking about the Red Sea and some of the potential inflationary pressures, particularly in Europe. Is that signal or is that noise for you?
I don't think anybody knows yet. The fact that we heard central bankers talking about this in Davos, and Lagarde mentioned it. We had Bailey talking about it in January. He mentioned it at a press conference. That's the Bank of England and the ECB, therefore, talking about this, and some others. And I think they're flagging it. But right now, we just don't know how much this is going to contribute. Now, certainly, if we look at shipping prices relative to where they were a couple of months ago, they've gone much higher. But we're still looking at nothing like the sort of situation that we had, after the pandemic. So for now, it's relatively moderate. But if this situation carries on for several months, then we could potentially be talking about another add-on to inflation. But right now, I would probably say it's more to do with reduced disinflation as added inflation, something subtle there. But right now, something to be concerned about, but nothing to panic about at the moment.
Hey, Jane, appreciate the update. Thank you. Jane Foley there of Rabobank with a 3-month target on euro-dollar of 1.05, questioning why maybe it should be even lower. You strip out the United States, the international story right now, Lisa. Not great at all.
Especially because you could even use the S word. I mean, it's almost stagflationary.
I thought you were thinking of a different S word then.
I was
checking
not.
the clock.
No,
This surveillance after hours.
All right. No, I'm not going after hours. It's still the morning. Good morning.
Good morning.
Thank you. But, honestly, I'm just thinking about going forward, what this potentially could be if you're dealing with wages that are increasing, for example, in Europe, but you also see industrial output really coming down.
The other S word works too, for whatever it's worth, which is why I thought that's where you were ultimately going. Coming up on the programme in the next hour, Kelly Kaminsky of Alpha Simplex, Block co-founder Jim McAlvey. Look out for that. Fantastic conversation through the hour coming up. Terry Wiseman of Macquarie, Herman Chan of Bloomberg Intelligence with NYCB down in the pre-market. Once again, from New York City, equity futures just a touch negative here. We're down by 0.04% on the S&P 500. Last week, Meta had a massive move higher on earnings. This morning, Snap It's getting absolutely battered in the pre-market, looking like a completely different company to the one ran by Mark Zuckerberg. From New York City this morning, good morning. The second hour of Bloomberg Surveillance up next.
The Fed just can't give you what the markets want the Fed to give you.
If inflation does continue to behave as it's been, the committee is a little just struggling to catch up to how quickly the data have moved and what to make of that.
This idea that you can have stable or improving economic growth, but inflation continuing to decelerate, we just thought that was never credible.
Interest rates, while they're a dampener, aren't really able to offset that big moderation of inflation that we're seeing.
The inflation genie is not fitting back in the bottle.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 totally unchanged. Let's work through some single names and start with Uber. Plenty of earnings out there this morning. Uber is doing okay. Lisa, better than expected.
People looking at fourth quarter earnings coming in, or bookings, I should say, coming in higher than expected. But I just want to note, this is their first annual profit for Uber since its IPO. And I wonder if this is a ride-hailing story or if this is a consolidation of the behemoth story, because Uber certainly is seeing growth that maybe some of the competitors are not.
That stock is unchanged. That looks boring. Let me show you a name that is anything but. Snap is down in the pre-market by more than 30%. We're talking about a third of the market cap gone in the pre-market. Unreal. Look at the numbers. We're talking about losses. We're talking about misses, Lisa. Nothing pretty about this. Everywhere you look.
Talking about ad revenue, which was the boon for the likes of Meta, which is interesting that you sort of juxtaposed Meta and the record gain that it had in market cap last week. They're talking about a challenging operating environment, particularly with ad revenues, talking about revenue increasing by 5%, missing the analyst projection. Also announcing another 10% reduction in staff to, quote, reduce hierarchy and promote in-person collaboration. Again, how much is this a Snap story and how much is this a macro story? How much is this a consolidation of all the business at Meta and maybe not at Snap?
Well, for some companies, the so-called tech recession is not over. The recession of 2022 that we saw play out quite brutally for even some of the big cap names as well. For some names like Snap, it's not over. It's
not over, and they're still reducing staff. They're still trying to right size. The focus on getting back to the office I find fascinating.
Yeah.
Tech was talking about everyone can work remote, and suddenly not so much.
Well, that has implications for what we're about to talk about now, which is NYCB. So I'm sure you're all following this bank at home. In the pre-market, it's doing all right. It's negative about 3%. It hasn't been doing all right over the last week or so. We're talking about double-digit losses in the last 4 or 5 days or something like that, Lisa, which is just absolutely unbelievable. We've lost more than half the market cap since the end of January. And the get back to work, get back to the office theme, this is what's hurting them. Commercial real estate in a big way.
And it hasn't been fully repriced. And we're talking about zombies. I want to go back to Tony Dwyer's zombie idea, because really it's this question of when does it actually come to the fore, because everyone's been talking that this is going to be a problem. And yet now suddenly we're seeing it come out of the woodwork. That is what I think is spooking people. The idea that we knew that this was an issue, and now suddenly it's become something more imminent.
For Secretary Janet Yellen as well. So yesterday on Capitol Hill, in front of the House Financial Services Committee, I believe tomorrow, Annmarie, in front of the Senate Banking Committee, becoming a bigger and bigger issue down in Washington.
I imagine she's going to get asked specifically about this again tomorrow, because she didn't want to comment on a single name, but she did say there is concerns in this sector, and she pointed to the supervisors. She said they need careful attention when it comes to supervisory. But we are aware that this could create financial stability risk or losses in the banking system.
What else can she say?
Exactly what you took the words out of my mouth. I mean, honestly, she can't be like, this isn't a problem. And she can't say this is Armageddon. It's sort of, we're carefully watching it. Trust us.
It's the lesson of last year. And we mentioned this in the last week or so. The lesson of last year wasn't a lack of regulation. It was poorly executed supervision. And I think what's interesting about our reporting so far this week is basically the regulator was leaning on the specific bank, according to our reporting, to do something about things and do something about it fast, which is not what we saw last year.
The fallout, though, is similar, which is interesting because even though regulators were on them to do something, it hasn't stemmed some of the losses, but maybe it has given people confidence that they have some supervision. We heard that from Jay Powell over the weekend, too. They're working with a number of banks. So everyone's saying, OK, who else? What does it rhyme like?
What other names?
Yeah.
NYCB is one of them, down by about 2.86% in the pre-market, much better than where it was a little bit earlier this morning. The broader market, in the equity market at the moment on the S&P 500, futures look like this. We're negative, but only down by 0.07%. In the bond market, yields are higher by 3 basis points, 412.88. Elisa wants this on repeat. 10-year notes come today, $42 billion worth. Elisa, tomorrow, $25 billion of 30-year bonds.
And I caveat this with, it's not going to matter unless it does, right? I mean, it's sort of talking about Yogi Berra quotes, but this is a sort of thing where if it gets messy, then people will start to talk about debt sustainability. And if it goes well, people will say debt sustainability is not in anyone's mind.
It mattered in October, not so much now, apparently. But that can change quickly.
Exactly.
That can change quickly, and it changed quickly based on just Treasury Secretary Janet Yellen saying, yeah, less longer-dated debt than you thought, than you expected.
And so what could shift the sentiment? There's really a question of how quickly can this change in a dime, and then how self-fulfilling could it be, given that sentiment begets sentiment and that people tend to get worked up because nobody really can follow the narrative at a time of deep uncertainty.
You don't sound frustrated at all. The 2 years up by a single basis point. The 2 year right now, 4.42. Coming up this hour, Katie Kaminsky of Alpha Simplex as the Fed urges patience on rate cuts. Jim McKelvey, co-founder of Block on banking regulation. Terry Wiseman of Macquarie on US exceptionalism. All of that and more still to come. We begin with our top story this hour. Fed officials continuing to push back against early rate cuts. Cleveland Fed President Loretta Mester saying this, quote, "It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. So is long fixed income still the new short?" Joining us now for more is Katie Kaminsky of Alpha Simplex. So, Katie, that's your line. Long is the new short. Is that still the case?
Yes, it is. And I think the biggest issue for me is that we have not been in position similar to a soft landing for 2 years. And now suddenly technical signals are agreeing with a soft landing narrative. Is this hope, or is this potentially something to worry about? That's what I'm thinking about right now.
How does that jive with what we've seen in the data Friday and again on Monday?
Well, I mean, if you look at fixed income, it's kind of in a holding pattern. There's definitely buying pressure, which is being pushed off for this huge hopes for cuts. So people are thinking we need to get in now before we get the cuts. But as you see from the policy speak, there is no hurry for cuts anytime soon. And so as a result, fixed income is sort of floundering back and forth between it's time to be long, but at the same time, it's going to take more time for cuts than people would like.
Katie, how much do you care about auctions?
We care a little bit, but it's exactly like you said. I mean, it's really a no op unless something really happens. And it is something that is a risk for the long end of the curve. If we are going to see continued higher for longer rates for a longer period of time, should we see that weakness in the long end of the curve, we might see the steepener without the cuts. So I think that's why people are watching it, just to see if that could show signs of some fragility in the system.
I was talking earlier about how I feel like it's deja vu all over again. We kind of feel like Back to the Future with this idea of, the no landing or soft landing and what we're going to do with a reaccelerating U.S. economy. If the Fed remains on hold for longer and isn't so quick to cut, does that give you more conviction or less conviction with the long bond call?
Well, I think bonds have gone through their cycle. We've seen an inversion. We've seen a flattening. And frankly, the next step is a steeper yield curve. And so if we do stay higher for longer, then, it could be weakness in the long end of the curve where people kind of lose some faith, which you have to watch for. I think for us, the biggest thing that is a concern is if you have upside risk in inflation that people are really hoping against. That's something that I think we worry about for this year.
So, Katie, let's drill deeper. Let's go through some scenario analysis. We've been trying to figure out around the table whether good news is good news for stocks. So we've been looking at the reaction in the bond market, strong data, high yields. Then we'll go to the equity market. Friday, we were OK. Monday, not so much. So, Katie, I'm trying to work out how that bond-stock correlation has been developing over the last few weeks off the back of these upside surprises.
So I think the biggest thing for us, going into what you're saying, is that everything isn't the same as it used to be. We're still seeing positive stock bond correlation, which is consistent with inflation still being a key theme. And we're also seeing heightened bond volatility, which is also suggesting that people are very uncertain about the direction of fixed income going forward. This is not consistent with a soft landing, we're there narrative. So I think that's something to watch, because it's something that indicates that asset prices are still really focused on inflation.
Is this consistent with a stronger US currency?
Well, I think the challenge here, and I think I want to point this out, this is something we're talking about right now, is the biggest challenge is going to be the role of China in this entire narrative. If you look at China and the BCOM, they have moved hand in hand. So the question you might ask yourself is, should China come back online, how many of these stories are going to kind of turn the other direction? China is a major player in terms of raw commodities, which often lead the pack when we come to inflation kind of roaring back. So I think that's what I'm interested in this year, is what happens in China and what is its role in commodity prices that could be sort of a huge factor that we're not thinking about.
Which brings us full circle back to the idea that asset prices, and you are very focused on inflation, the potential risk of a reacceleration. Do stocks hold in that case? That seems to be what a lot of people are saying, is that stocks are a better bet right now than bonds or cash, should we get that inflation surprise.
I'm going to think about it. I mean, I agree, because when you have an inflation surprise, it goes straight to bonds. Those are long-term cash flows. Inflation, especially in the short run, isn't so bad for equity markets. I think the challenge is when you hit more restrictive financial conditions, which frankly, the data is not suggesting yet. And so as a result, equities are still looking relatively good, and the US is really looking ahead of other regions. So I think that I would agree with that.
US exceptionalism is a theme all over again. Katie, thank you. Katie Kaminsky of Alpha Simplex. We'll catch up with Terry Wiseman of Macquarie about that later this hour. Your equity market on the S&P 500 is totally unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Online talk show host Tucker Carlson has interviewed Russian President Vladimir Putin. The former Fox News anchor was spotted in Moscow in recent days. The interview is Putin's first conversation with Western media since the beginning of the Russian invasion of Ukraine. Carlson says he also intends to interview Ukrainian President Volodymyr Zelensky. Shares of Snap plunging in the pre-market trade this morning, following disappointing revenue from holiday quarters. Fourth quarter revenue came in at $1.36 billion. That missed analyst projections of $1.38 billion. The parent company of Snapchat has been restructuring over the past 2 years and announced that they'll cut workforces by another 10%. Nearly 68 million Americans are expected to place a bet on this year's Super Bowl. That's according to the Gambling Industry's National Trade Association. And that's a 35% jump from last year. The total value of bets is estimated to surpass $23 billion. But of that, just $1.5 billion is projected to be with legal outlets. Sunday's Super Bowl pits the Kansas City Chiefs against the San Francisco 49ers. And that's your Bloomberg Brief. John.
That stat's amazing. Not the 68 one, the other one. Danny, thanks for that. That's phenomenal, just to hear those numbers.
Yeah, but how much of that is like squares and things like that? People kind of betting across the table versus real kind of formal illegal bets.
Are we going to do our own bet here?
You want to bet now?
To be honest, I don't know anything about these teams, so no.
Okay, so the answer to that is no. We can do that in a commercial break if you want, like for $1 or something like that. Up next on this programme, Treasury Secretary Janet Yellen on Capitol Hill.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
That conversation up next. This is Bloomberg. Live from New York City this morning. Good morning to you all. The equity market on the S&P 500 slightly lower by 0.04%. Yields are higher by 2 or 3 basis points on a 10-year 412.88. Under surveillance this morning, Treasury Secretary Janet Yellen on Capitol Hill.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
Here's the latest this morning. Yellen voicing concern over losses in commercial real estate, stopping short of commenting on a single institution. This is Moody's cuts New York Community Bank Corp to junk, and shares hit their lowest level since 1997. Herman Chan, senior US regional bank analyst at Bloomberg Intelligence, joins us now for more. Herman, is this the worst of it, or is there still more to come?
Look, there's probably still more to come in terms of what's going to happen next with New York Community Bank, and then for the broader regional peers that do have exposure to areas of concern like commercial real estate. So the story's not over yet, and we're bracing for some more bumps in the road.
Herman, do you have a sense of how many banks the Federal Reserve is talking with right now and trying to oversee, as well as the Treasury, as we heard from Janet Yellen yesterday?
Yeah, I think the banks that really have higher exposure to commercial real estate, there's a regulatory ratio that's been discussed, about 300% of commercial real estate as a percentage of your total capital. And there's also another regulatory marker, 100% of construction lending as a percentage of total capital. So banks that clear that metric may have higher regulatory scrutiny in this current environment.
The good news is that NYCB is down 5%. Herman Chan at Bloomberg Intelligence. Now, I say that's good news because yesterday we were down by 22%, at least. So the day before we were down by almost 11%.
So basically, this is what, a revival, because it's only down 5%. This is stabilization at $4 a share.
Down double digits Thursday, down double digits Wednesday. We've lost more than half the market cap of this bank in just about a week.
Which raises this question of, OK, first of all, can it continue? Does this really jeopardize some of the relationships? When you have to come out and say this doesn't jeopardize a relationship, it's not a good thing to hear. But then also, how far does this go when you see the KBW index of regional bank stocks down 11%? Since January 29th.
I think we've all been excited for this conversation all morning. Joining us around the table is Jim McCalvey, the co-founder of Block and former chairman of the board of the St. Louis Fed, joining us around the table for the rest of this hour. Good morning, sir.
Thank you.
Good to see you, Jim.
Yeah, it's going to be a lot of fun.
We're going to have a lot of fun right now. Maybe not on this topic, though.
Let's start with the gloom.
Let's talk about the stress in the regional banking sector. Your thoughts on last year, which seemed to be rate stress. This year, is it going to be the year of credit stress?
Well, I mean, everyone was worried about the banks because there's such a concentration in commercial lending. And commercial real estate isn't worth what it used to be because people aren't going into the office. But the good news is, and at the last Fed meeting that I was in Washington, D.C., we discussed this. The good news is it's a problem, but it's not a surprise. So everybody saw this coming. So it's baked into the rates. And you're seeing it play out in the numbers right now. We're discussing that. But this isn't going to come as some pandemic-like surprise where all of a sudden it knocks the world economy over because we didn't see it coming.
It begs the question why some of these banks hadn't already provisioned for it.
Well,
NYCB came out in the last week and did just that.
Well, it was a crash. I mean, the pandemic hit, people stopped going to the office, you had these long-term commitments, these mortgages, and that doesn't unwind instantly. So you can't get out of it. It's a game of musical chairs. I mean, you're stuck with it. You know you're stuck with it. Everybody knows you're stuck with it. So you can't just dump it on some other sucker.
Well, so as someone who
SoftBank is
yes,
right.
well, I mean, we could discuss.
We could talk about that.
Yeah, we can have a lot of fun with
that.
We miss you. We miss those days.
We could talk about Adam Newman going back to WeWork, but I am curious.
I get you.
But I'm just curious. When you take a step back, whether some of the disruption in some of the models makes it more difficult to sufficiently understand the risk. We're talking about, for example, SVB. I'm thinking about some of these other banks in terms of concentration, in terms of just their concentrations of particular asset classes?
Yeah, so the models have been, sort of slow to respond. But, I mean, if you look at it, the system really performed quite well during the SVB situation because the SVB was sort of a weird bank. It had this very weird concentration of behaviors and deposits and this sort of niche-y thing in Silicon Valley. And when it blew up, the system reacted so quickly and so well. And there was a question, were we going to, bail out uninsured depositors? And the answer, internally, which we all knew, of course we were, because it's the regulated financial systems. You can contrast that with an unregulated system, like what happened with FTX. There was, again, a problem, but there was no regulation. There was nobody in there to, sort of, no adult in the room. I mean, I think literally. And it collapsed, and people got wiped out. So, what I look at is, sort of systemic risk. And the FTX disaster was a disaster, but it sort of proved that the model worked. Now, could we regulate better? Yes. Should we? Absolutely. And we're changing the models. But, I was on the Fed at the time, and if you watched how the Fed, the FDIC, and the Treasury all responded in, in real time to a problem, it was very comforting.
Well, so you've been on all sides of this, which I love.
Yes.
Because you've helped, you founded Block, and you also have seen it from the regulatory standpoint. You talked about SoftBank. We're talking about zombies. How many bad actors are there left who haven't been exposed in some of sort of the new finance?
Lots. There are always lots of the bad actors. Look, it's not some sort of thing like we extinguish it. These people move from thing to thing, and a lot of them get to find the next thing. I don't know what it is. I'm sure there's going to be a lot of fraud in AI. I assume there's going to be a lot of fraud. There was tremendous amount of fraud in advertising. So we just saw what happened with Snap and Bloomberg. And, advertising for years was this just total cesspool of unregulated fraud. And it's still going on right now. That's why companies like, Bloomberg are so amazing, because you guys actually are a solid, fact-creating, fact-reporting company. Whereas most of them, you look at what's happening with Dow Jones, look at how, sort of the news world, it's just imploding.
Because of AI. And you think there needs to be actual regulation for that?
No, it's not. It's not AI that's killing news. It's the fact that, basically the platforms have hoovered up all the ad money. Yeah. Bloomberg being the exception.
How are we going to confront an era of disinformation, the potential of that coming from AI in the years to come? What's the best way of doing that?
Nobody knows right now. I mean, I think in the world of AI, we absolutely need to start thinking about regulation quickly, and not just, sort of government regulation. I think what we need is a market of regulation. So in other words, we want to have for-profit companies that are monitoring artificial intelligence developments. Much in the way we have Underwriters Laboratories, certifies, probably this keyboard has a UL listing on it.
So since you've been on all sides, I love that you've been on the government side. You've also been on the innovation side. There's been this sort of angst that governments can't pay enough to get the talent to actually counter some of the AI threats and get ahead of them in any real way. Do you pay credence to that kind of idea?
We can pay enough. It turns out you don't actually have to pay top dollar, because, when I was at the Fed, the Fed has a cap. We're basically not allowed to pay much more than the president earns to hire people. So we were hiring people and paying them a quarter or a tenth of what their market rate would be. But there's some people who will work that way. There are a lot of actually excellent people who come in and do that. So it's not just a question of throwing dollars at a problem to solve it.
We see that at the Federal Reserve. I think you can earn more as a regional bank president, say on San Francisco, for instance, than you can as a governor of the board of the Federal Reserve, which is kind of nuts.
Yeah, I mean, when Chris Waller moved to D.C., it was...
Took a pay cut, didn't he?
Oh, no, well, not much of a pay cut, because he was already working for the Fed in St. Louis. But I mean, the poor guy couldn't afford housing. This is in D.C. This is a real problem. So I think we should allow the government entities to pay more. I think that would be a good thing, that we shouldn't have this artificial salary cap, because it is hurting. I want to set up the next segment with you as well, Jim, because you're going to be sticking around with us. I've always wanted to ask you this. Why the banks here in America didn't create Block? How they missed this? How did that happen? So, I mean, I read an entire book on this. It's called The Innovation Stack, which I shouldn't promote it because it was published 3 years ago. I published it during the pandemic, so nobody wanted to read about it. But look, if you think about the world of innovation, the truly transformative innovation always happens outside of the market. Because what the market does, the market fills its space, and it says, okay, we are going to serve people down to this level. And when Block started, which we used to call Square, when Square started, the ability for small merchants to transact using the same tools that the big guys had wasn't there. And so we built an entire system underneath what the market at the time was. And as a result, millions of little businesses were able to then, have the tools so they could take payments and they could do their payroll. They had, we gave them all these tools. But that, by definition, never happens from within the industry. So, my research for the book basically showed this pattern again and again. So the same thing happened, great example would be airlines, okay? So at the time before Southwest Airlines, airlines were basically the tool of the rich. You could travel in an airplane if you were rich or if somebody else was paying for it. But normal people took the bus. And Southwest Airlines basically invented what we now think of as air travel because they made it cheap. They made it, affordable to everybody. And that innovation never comes from within the industry. So the banking industry, as it existed in 2009 when we started Square, was never going to do what we did.
We're going to keep talking about it. I also want to know if you take any blame for what happens now when you go to get a coffee and they flip the screen around and
tips.
Yes.
up to 25%.
Yeah.
I wondered if you actually take responsibility for that, Jim. Jim McAlfee's going to stick with us from New York. This is Bloomberg. Stocks on the S&P 500 going nowhere, totally unchanged. Equity futures this morning look like this. We're positive 0.08% on the Nasdaq 100. On the Russell, the small caps, rock bottom in yesterday's session. The financials this morning down another 0.5%. We'll talk about NYCB a little bit later. Let's turn to the bond market. 2-year, 10-year, 30-year. Plenty of supply coming a little bit later. I've talked about the 10-year issue. $42 billion of 10-year notes coming later. $25 billion of 30-year bonds coming tomorrow. Your 30-year this morning is up 3 basis points to 4.33. Lisa, up 3 basis points on a 10-year to 4.12.69.
I'm watching the auctions to see whether there's something that comes to the fore that's a little bit less positive than yesterday, in particular because longer-term inflation expectations are starting to creep up as we get this better than expected data. And it raises this question, when does that start getting priced in addition to deficit issues and sort of the risk premium that people talk about?
That's the bond market. Here's foreign exchange. Jane Foley speaking to Lisa, Annmarie and me a little bit earlier of Rabobank on euro dollar looking for 1.05 in the next 3 months or so. We're at 107.70. The real question right now, Lisa, is why not lower than that? Why not parity all over again based on what the data looks like in America versus what the data looks like over in Europe at the moment?
Does this thing ever move that much? I mean, I think that maybe
We've
that's
had a breakdown from 110, haven't we, to 107?
Exactly.
What
It's been shocking for a couple of months. But here's the question, right? Essentially, because there is this big divergence with the U.S. outperforming Europe, when does that start to play out a little bit more in a predictable manner in
the euro,
currency?
Just a touch stronger. Is that enough price action for you?
Fantastic.
Just a little bit. Under surveillance this morning, your top stories. Your first one, Secretary of State Antony Blinken heading to Israel with a peace deal building. Qatar saying Hamas gave a, quote, positive response to a proposal which would see a pause in fighting and the release of some hostages. Blinken saying the US is studying the Hamas response and has shared it with Israel. Annmarie, we've been closer and closer over the last week. How close are we?
Well, Biden yesterday, when he came out to talk about the collapse of this border deal and was asked about this Hamas ceasefire potentially, says there's been some movement, but then he said their response was a little bit over the top. What does that mean? What did Hamas ask for that the president said was a little bit over the top? And then how does Blinken, his 5th visit to the Gulf, to the Middle East, he's in Israel today, how does he sell this to the Israelis? When you have Netanyahu saying basically that they are not going to stop until it's total victory in terms of crushing Hamas.
The 5th visit in about 4 months and likely, sadly, not going to be his last either. Let's turn to this story. Every time I do Boeing, I do give a warning. If you're flying this morning, turn the volume down a little bit. Just for a moment. 4 bolts were missing from the panel that blew out on the Alaska Airlines flight last month. This is nuts. According to US investigators, photos from a preliminary report by the National Transportation Safety Board suggest the bolts were removed at Boeing's factory and not replaced. In a statement, Boeing CEO Dave Calhoun saying, quote, whatever final conclusions are reached, Boeing is accountable for what happened. I mean, Lisa, where to begin with this story? Where to end?
I don't want to have to look at what plane I'm flying, and yet that's where I've started to look. But I just, again, bolts not being put in is not something that you want to hear, and it raises this question about the duopoly. You can't get away from Boeing. So what do they do to try to shore up their production?
Well, I was actually on one of these Boeing flights on Alaska. Went back, and it was one of those flights. I just hope it wasn't one of those that was missing these 4 bolts. Wall Street Journal this morning, FAA keeps trying and failing to fix Boeing. Is it a Boeing problem, or does the FAA need to get more involved? Which they were on Capitol Hill for grilling yesterday.
Jim, I've got a feeling you want to jump in on this story. What have you made of this?
Wear your seatbelt. I mean, look, the FAA does a really good job, but they've got a problem, which is there's one manufacturer. I mean, we used to have Lockheed, we used to have McDonnell Douglas, we used to have Boeing, and they would compete, and that competition has now been sort of sucked out of the market. You've got Boeing versus Airbus, but Airbus is this sort of weird, sort of state-sponsored weird thing. They both build good planes. So Boeing, they're solid planes. The planes are safe. But, fundamentally, they've got some management problems, and their president basically just said, oops.
Why isn't there more innovation in this sphere? Why can't we have something that breaks out from a duopoly where suddenly another player kind of challenges this?
It's the economics of building large planes. There's so much regulation, there's so much capital required that you just can't stand up one of these things. Now, the Chinese may be able to do that, but I wouldn't jump on one of their planes anytime soon. The Brazilians are actually building some pretty decent planes. And then the private market actually builds, sort of interesting experimental aircraft.
Yeah.
What the cool thing is that, at least in the United States, we have this thing that allows you to fly anything as long as it's written experimental on the side. So if you go to the EAA, you can literally, literally, we could put balloons on this chair and legally fly it.
Just so long as we write experimental.
As long as you put experimental on it, it's safe. And so it's actually a really good system for innovation because you'll see a lot of really cool things like, basically drones that you can fly now. And they're all over the skies. They're just not things that you would buy a commercial ticket
Just so long as it's not a plane made in China with experimental written on.
Yeah, you don't want to. I don't know what the Chinese word for experimental is, but it's probably tattooed on somebody's neck.
Let's not go there. Let's not go there. A game-changing moment for sports streaming. Let's go there. Disney's ESPN, Fox, and Warner Brothers Discovery are joining forces to launch a streaming platform. The service aiming to attract viewers that don't subscribe to a pay TV package, but offering them all of the sports that would be included, from the NFL to college basketball. The unnamed service is set to launch by the fall. We don't have a price either, Lisa, but Geetha Raghunathan of Bloomberg Intelligence suggesting something like $40 a month.
But to me, this really raises the question about whether the new disruption is going back to the old. I keep thinking, what is the new model for entertainment? I'd love to actually hear Jim's thoughts on this. What's the new model for entertainment at a time where streaming is kind of coming full circle and there are these disparate services, and how do you consolidate enough eyeballs and capital to really make it work?
Jim, thoughts?
So there are only three models that pay for content. There's subscription, there's advertising, and then there's pay-per-view. And we've never really gotten pay-per-view working well. I've spent the last 6 years building something called Invisibly, which allows you to basically sell your eyeballs on your terms and buy piecemeal whatever you want. So you can get the Wall Street Journal, you can get the Atlantic, you can get, right now all we have is news. All we have is news and journalism, print journalism, which it turns out most people don't want. They just, we handed it to them, and not a lot of people were eating from the buffet. But I think eventually what we're going to have is a system where if you want to see the game, you have access to the game, and some intelligent agent, some basically a robot that works for you will say, oh, Lisa wants to watch this, so she'll pay 30 cents to see this game, and then the money will flow and everyone will get paid. And that's ultimately, I think, the solution to this, because it's bundling and unbundling and signing up, and where's the game, and I have to sign up for Peacock in order to watch the Kansas City Chiefs and see if Taylor Swift showed up.
I feel your pain.
Yeah, it's nuts, and it's frustrating. But we're in this world right now where these are all things being worked out.
Let's go to the data that you have access to and how it enables you to make some political predictions. What kind of predictions are you making at the moment?
So Invisibly has a political polling arm that weirdly has been calling the elections correctly. So we called the Trump-Clinton, the Trump-Clinton election correctly. We called the last ones. The data right now is really interesting. The Democrats are likely to run the only person who could lose to Trump. And the Republicans are about to run the only person who could lose to Biden. And if either side would pick a different candidate, at least from what we've seen, they would win. But it looks like we're going to have this really weird standoff of, sort of the statistically least likely candidate in both sides.
What is the data telling you on who would win this rematch?
Right now, Trump. Yeah, that's that. I mean, but look, so early to tell. And look.
And what's the spread?
It's too close to call. I mean, it's a couple of points. It's because what happens is you have these weird voters who don't respond to polling correctly. And one of the ways that Invisibly gets decent polling is we troll the worst parts of the internet. Like our ads run in the places that nobody admits they go. We get all that data, and it turns out that accurately predicted the elections in the past. So we hope it's going to still work.
So when Quinnipiac call up, people aren't honest with them. Is that basically what we're finding?
Yes. If I stand there with a clipboard and I say, John, who are you going to vote with? You tell me.
I'm here for Bloomberg Morning Consult, and we're not telling the truth. Is that basically?
No, but it turns out you just had the conversation with the cameras off. We had a very frank conversation, which none of you guys got to hear. This is the fact. When you poll somebody as controversial as Donald Trump, a lot of people tell you what they think you want to hear, and they don't honestly answer. So we get them where they really are, and they answer honestly. And
So, honestly, what are the worst parts of the internet? I mean, there's a lot of bad. That's
oh,
pretty
there's
obvious.
so much.
Right.
There's so much.
You really wanted to go there. I wasn't trying to go there.
All right, fair.
I think we saw a similar
I forgot to
thing.
say it's called surveillance. Like,
Oh,
I think we saw a similar thing with Brexit back in 2016.
Yeah.
That people were polled, and it was the difference between a telephone interview versus an in-person polling and all of that stuff as well. Is that what you're finding then?
Yeah, what we find is that if you ask them the question on the page and you don't pull them off the page so that they trigger into this, oh, I need to answer correctly, then, or I should say honestly, they will answer honestly if you don't disturb them from the cat videos or people of Walmart or whatever else
This
they're
brings
doing.
up quite a philosophical question. It's who monopolised the moral high ground for the public to believe there was an answer to the question that you wanted, and the answer that they did have, they felt like they had to keep in private. And it makes me wonder whether we've sort of lost where the country is actually in reality, and that the leadership is out there trying to please maybe the fringes of society without really directing it down the middle.
Yeah.
Have we lost track of where this country is?
We have, I think, because a lot of the leadership is on the coasts, and a lot of the energy is in the Midwest and in farm states and in places where, you know, normal people feel like they don't have a voice. And I live in St. Louis, Missouri. I'm from St. Louis, and this is the spirit out there. And I've watched this develop over the last 15, 20 years. We're not properly connected to the center part of the country.
We've already seen AI play out in this election, deep fakes on people's voices. How concerned are you about that?
Oh, terrified. I'm just absolutely terrified and impressed, like it's gotten really cool. But yeah.
Spoken like a true
You're
innovator.
impressed because it's so good, and that is scary.
It's fantastic, and it's going to be the tool that changes lives and changes the way we work and changes the way we think. But right now, it is so dangerous to use the old system. So we used to say, oh, if you had something that was typed, it was legit because it cost money to have a printing press. So if it was handwritten, it was possibly fake. But you couldn't fake type. And then we got laser printers, so everybody could fake type. And then we got the internet, so everyone could fake news. And now we have AI, so anyone can fake video. Like, I might not be saying this.
He is.
Thanks, Annmarie. Well, I want to go back to something you were talking about with this sort of disenchantment, the point that John was making about the gap between leaders and the populace, and what you make if you sort of dovetail that to the economic picture, where the overall economic data seems to suggest real strength. And then you talk to people and they don't feel good. And everyone's been trying to figure out this dissonance and say, well, maybe it's just because it takes time for inflation to come in. What do you make of it?
I think there's a lot of accentuating the negative in news because the news cycle has to get eyeballs, and eyeballs are going to come to you if you make people hysterical. And you do that again and again on a 24-hour cycle. And people eventually start to get depressed and start to think that their system is, being attacked. And then you've got the, sort of siloization of information where, you get your information from the sources that you want to. And then the algorithms, this is, what YouTube is famous for. The algorithms will serve you the stuff that makes you the most engaged. And engaged is pretty much enraged. So if I can piss you off, then you're going to give me your attention. I will take that attention. I will sell it. And that's really unhealthy. And that, at scale, gives us this tremendous division that we're seeing right now. And I think the solution for that is for us to take control of our eyeballs, by essentially having AI or intelligent agents working on our behalf, sort of pulling from the news sources as opposed to having it shoved down our throats.
Jim, you're going to stick with us, I'm pleased to say. I've got to squeeze this in, though. Are you single-handedly responsible for tipping culture going absolutely insane in the United States of America?
Not single-handedly, but we had a big part of it. I mean,
it's amazing what's happened.
And I will tip you for asking me that question.
Are you proud of it?
I don't have Block with me, but I'd flip the screen and select 20%.
I don't think he's ashamed. I think you're proud of it.
No. Look, look, you have a whole class of workers that weren't being appreciated, and I think we gave them a way to express appreciation. And has it gone too far? Sure, because everybody's copied what we were doing. But is it appropriate that we treat the people who serve us well? Yes, I think it is. And I think they've been underappreciated for a long time.
Couldn't agree more, Jim. You're going to stick with us. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. PIMCO says the Bank of Japan may scrap its negative interest rate policy as soon as March and hike multiple times this year. The firm predicts the central bank will raise its benchmark rate to 0% in April or March before hiking by a quarter point by the year's end. PIMCO says quickening wage growth will likely create persistent inflation, allowing the BOJ to exit negative rates. House Republicans are vowing to bring back articles of impeachment for Homeland Security Secretary Alejandro Mayorkas to the floor. The initial vote failed 214 to 216 after 4 GOP members sided with Democrats. But the Republican majority expects to hold another vote once House Speaker Steve Scalise returns from cancer treatments. Republicans charge Mayorkas with refusal to enforce immigration laws and failing to secure the border. Donald Trump, meanwhile, has been denied immunity in his case surrounding the efforts to overturn the 2020 election. He attempted to claim that a sitting or former president is immune from criminal charges. The ruling was unanimous from a Washington, D.C. federal appeals court and now moves Trump closer to the possibility of facing a trial ahead of November's election. The Republican frontrunner has until Feb 12th to appeal the ruling to the Supreme Court. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, another round of U.S. exceptionalism.
We are seeing a difference in outlook. The growth position in Europe is weaker. We've seen stronger growth in the US.
That conversation coming up next from New York. This is Bloomberg. Stocks on the S&P 500 doing okay here, positive by 0.1%. If you're following the fate of NYCB in the pre-market, that stock is now higher by around about 10%, 462 in the pre-market right now. Under surveillance this morning, another round of US exceptionalism.
We are seeing a difference in outlook. The growth position in Europe is weaker. We've seen stronger growth in the US, and the European economies have taken a much bigger hit on inflation because of their exposure through the energy price. So, they've had a more difficult, challenging period over the last couple of years, and the growth outlook is a bit weaker, including because of actually an aging workforce in the euro area as well compared to the US, where we've seen some remarkable strength in the last couple of years.
Here's the latest this morning. US economic data continuing to surprise to the upside. Macquarie's Terry Wiseman writing this. When and if the US is no longer surprising positively versus the rest of the world, the dollar will weaken. For now, over the last week, the dollar has been stronger. Terry joins us around the table for more. Morning, Terry.
Good morning, John.
Any reason to believe this won't continue? Just how good are things in the States and how bad are they everywhere else?
Things are pretty good in the States, but you can point to a few excesses in the States as well. And when we look forward, I think as economists, we should ask ourselves, where are the excesses and can they last? I'll point out one. The personal savings rate in the U.S. is 3.7% as per the last month of data. That's low compared to historic norms. We're used to having in the United States a savings rate that is, around 5%. And just prior to the pandemic, we had a savings rate of 7%. Are people saving enough for retirement? Probably not. Are they going to wake up to this fact? At some point, they might. At that point, they're going to start to reduce their consumption. And at that point, we might see that consumption-driven slowdown. Has it happened yet? Absolutely not. And it's very difficult to predict when it's going to happen. You can make a case that it can happen organically. People just wake up and say, hey, I'm not saving enough. Or they're shocked into saving more. It could be a stock market crash. It could be a sense from just reading the headlines that there's a problem in the commercial real estate sector. Something might cause that. When that happens, you'll see the economy slow, but it doesn't have to happen in the next few months. There's nothing that is militating for that to happen immediately.
It feels like we're putting a bunch of previous years on repeat this year. And I was just thinking that all morning. I feel like the same stories are coming up again and again, and this is one of them. Soft landing, no landing, we can just push it out. We're going to get the weakness. It's just going to happen later. How do you sort of factor in some of the data that's highlighting a lot more strength than people expected into this? It's going to come. Just wait. You'll see.
Look, some people are momentum people. They look at the trend and they simply extrapolate it. I'm not that kind of person. I don't care about the past. I just care about the future. But there's some validity to saying that, hey, if things are going well, they're just going to continue to do so because, on a short-term basis, that usually works. And if all you have to do is predict what's going to happen in the next month or two, then saying, look, the economy's strong, going to be strong in the next 2 months because it's strong today, is not a bad approach, okay? Given that the probability of these shocks coming in any given month is low, okay? But when you extend the horizon to a year or two, well, that probably goes up, okay? And it all depends on what your investment horizon is. If it's 1 or 2 months, yeah, probably nothing's going to happen. If it's a year, you've got these worries, right? Is the personal savings rate going to stay as low as it is? More importantly, are we going to have a problem in commercial real estate, right? That's the other excess.
There's plenty. Terry Wiseman of Macquarie around the table with us, together with Block co-founder Jim McCalvey. Jim, you're affiliated with Emerson Electric as well.
Yeah, I just joined the board last June.
What are you finding they're telling you about the global economy right now?
So normally I'm not allowed to share this, but we just released earnings like an hour before this program started. So I bring to you good news from the world economy. So this is really cool. Emerson Electric, nobody's heard of them, but they've been around for over 100 years, and they make the stuff that makes the stuff. So they make valves and control systems and industrial automation. So if you're building a plant anywhere in the world, you're probably using Emerson equipment. So their sales basically show us if the world is optimistic. And I have the numbers here, hot off the press. America's up 8%, Asia and MEA up 15%, Europe up 10%. It's up worldwide. And we have not seen something like this in many years. Now, part of this is just Emerson's a pretty well-run company, so these are their numbers. So you have to take out the sort of well-run part of Emerson. But even if you just look at the broad sectors, the world economy is doing really well. And so this is data that I think it should be very encouraging for everybody, because the world economy is really the thing that keeps us all together as a planet. And if everyone's making money, we don't have as many wars, we don't have as much problems. And this is very, very good news. It just came out.
Terry, does that make you feel good?
It does, but at the same time, I have to wonder about what the role of China is going to be in this story this year. There's a lot of excess manufacturing capacity in China these days, and if they do not get aggregate demand to pick up and households to start to buy, yes, manufacturing would do okay, but it will be led by China. China may dump those goods on Western markets, barring tariffs and non-tariff barriers. And then you'll see manufacturers, outside of China feel the pressure. And to some extent, that's already happening with electric vehicles. It's happening to some extent in the U.S. as well. Maybe we haven't seen as much of it because the consumer has stayed strong and has continued to buy goods pretty rapidly, pretty aggressively. And that's keeping the manufacturing sectors around the world okay. But I wonder if profitability will stay strong in view of this excess manufacturing capacity in China that can be dumped into the rest of the world.
I also wonder if those American consumers will show up if there's going to be 60% blanket tariffs on Chinese goods if the former president becomes the next president.
Right, and we at Macquarie have been talking about that, right? I mean, you could have a situation where, in the case of foreign currency, in case of the dollar can actually strengthen in the event that we have tariffs put on Chinese goods, right? Because Americans will be forced to look to their home market to purchase things, and that would be strengthening the dollar. It could also get the Fed to potentially hike or more or cut less than they otherwise would. So yes, if the point is that politics is very important with respect to whether this how the pie is divided around the world with respect to this manufacturing boom, I would agree with that. And I think the next few months in particular, because of the elections around the world, not just in the U.S., is going to be very important to determining how that pie is sliced.
You've both touched on the same topic, so let's go there. Jim, if things are so good, why are we talking about trade wars still? Why are we seeing wars take place in places like Ukraine and the Middle East as well? Why are we seeing heightened tension? To your point, if things are playing out quite nicely.
Well, I mean, look, it's a big world, and people get along and don't get along, and I can't explain war. Thanks for the softball question, but I got nothing to add. But look, generally, if you look at the trends that we're looking at, you have things like decarbonization. We've recognized that the planet is heating up, and we've taken meaningful steps to build technologies that are going to address that. And this is one of the things that Emerson does. They build the things that give us green energy. They build us things that that are helping that transition. And those factors are worldwide and very positive. Now, are there going to be wars and problems? Absolutely. But the fact that we're looking at these sort of global supply chains, and everybody kind of has to get along, because you're just not going to work as any single entity. I mean, even if China decides to sort of go rogue, they can't. Nobody. The U.S. can't. Like, we're all connected, and that just makes it better.
I think ultimately this is what we're getting at. We used to think that trade relationships prevented conflict, and then we've seen what's taken place between Russia, Ukraine and Europe. It hasn't played out that way at all. We had a massive trade relationship between the US and China, and yet we've still got tension on that front as well, Lisa.
Yeah, this is true, which is the reason why people haven't bought into this tone shift that we've heard from Xi Jinping in response to the lack of direct investment. This is one of the key questions. When does it become a real problem?
Terry Wiseman of Macquarie. Terry, good to catch up. Jim, we could speak to you all morning. This was awesome. Let's do this again soon. Thank you, sir.
So much fun.
Jim McAfee there, the Block co-founder. Coming up, Republican Senator Rick Scott of Florida, Keith Lerner of Truist, Kathy Bostjancic of Nationwide, and Michael Nathanson of MoffettNathanson. All of that and a whole lot more. The third hour of Bloomberg Surveillance up next.
It seems like the stage is set for the Fed to have a slow decline in rates.
If you continue to see that strong growth, you could actually get that soft landing that we had been looking for.
It does seem ultimately growth is going to have to slow.
If the economy slows more than sort of a Goldilocks landing, the Fed has room to cut rates maybe a little bit more.
I do believe in Goldilocks. Productivity is higher, and these trade-offs are going to continue to be the Fed's dream come true.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The last hour of Bloomberg Surveillance starts right now. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by almost 0.2%. Recovering in the pre-market, NYCB. Check out this stock in early trading, positive by almost 12%. Briefly, off the back of this story, Lisa, we have a new executive chairman to work alongside the CEO.
Again, this takes me back a year or 11 months. The fact that we're even talking about incredible volatility in a name, understand that it is trading below $5 per share. So you're talking about a lot of volatility with a lot less potential market capitalization. But how do you right-size the ship when you've lost credibility? How do you right-size the ship in the face of more zombies in the form of commercial real estate that still have yet to rear their head?
Just to share the name with you, Alessandro Dinello, who had been the non-executive chairman and previously ran Flagstar Bancorp, which NYCB had actually bought back in 2022. So that's a name for you. Executive Chairman Alessandro Dinello to work alongside the CEO to improve all aspects of the bank's operations. Just off the back of that news, the story pushing higher, the stock pushing higher. But to Lisa's point, this one has been absolutely pummeled over the last week, losing more than half of its market cap. Yesterday, we heard from Secretary Yellen on Capitol Hill in front of the House Financial Services Committee. Tomorrow, Secretary Yellen in front of the Senate Banking Committee. I imagine this is going to come up all over again.
And given the fact that now this stock, which she didn't want to talk about a specific company, but now it's a penny stock, she might have to say a little bit more. Yesterday, her quote was, "I'm concerned," but she thought it was manageable. But to John and Lisa, to your point earlier in the last hour, what is she going to say? Of course she has to say she's concerned, but she also pointed to requires careful supervisory attention, which maybe compared to 11 months ago, the supervision is actually in place and looking at what's happening in commercial real estate.
We're talking about a $4 stock now, sub $4. And to Bramo's point, getting a lot of volatility throughout the whole of this morning so far. The broader market, the S&P doing okay, positive 0.2%, about 88 minutes away from the opening bell. Yields are higher by 3 basis points. Lots of supply through the next 24 hours or so. Up 3 basis points to 412.69. And the euro stronger, dollar weaker. Just a little bit of strength there for the euro. 107.73. That currency pair positive by 0.2%. Coming up this hour, Keith Lerner of Truist on why stocks still have room to run after hitting all-time highs. Senator Rick Scott on the border bill that's dead on arrival, according to some, and him. And Michael Nathanson of MoffettNathanson on sports streamers going back to the bundle. Michael, later this hour. We begin with our top story this hour. Stocks moving higher as traders digest earnings and signals about the Fed's path forward. Keith Lerner, co-CIO and chief market strategist at Truist, saying this: after ending with a bang in 23, and a 9-week winning streak, the market is holding up relatively well. After a healthy digestion phase in the first 2 weeks of the year, the S&P 500 broke to an all-time high. This reiterates the importance of the Fed's ability to engineer a soft economic landing, which the market appears to be pricing in. We view this as a positive signal. Keith, I'm pleased to say, joins us now for more. Morning, Keith.
Great to be with you all. It sounded better than when I wrote that, so thanks, Jonathan.
Thank you, Keith. That's what I'm here for, just to make everything sound better. Let's talk about this equity market. You make this sound better. Are we standing on the shoulders of fewer and fewer stocks?
We are, and that is the risk. I mean, I think, as I've heard a lot of the guests, everyone wants to see this market burn out. We know it moved from the Magnificent 7 to the Magnificent 5, and maybe that changes to Magnificent 2 at some point. So we do need to see some things burn out. I will say, as you think about the overall market, we mentioned the market for 2 years didn't do anything, right? We had this big move up since October, but the last 2 years are basically flat. When you break out to an all-time high after a prolonged period, 1 year later, you're up 13 out of 14 times. Now, the caveat, the one time you didn't go up, which is what we should be focused on, is the signal from 2007, where there was a recession afterwards as well. Now, we still think recession risk is potentially out there, but we think it's not the base case at this point. I know the street is moving more towards a soft economic landing as well. But the risk, to your point, is the crowding. The equal weight index has underperformed the market cap by almost 20% over the last year. It's only happened, the extreme that we've seen is back during coming out of COVID and then back to 1999 as well. So we certainly need to see some better action from the broader market.
Last time I looked, I think we were seeing 9 points of outperformance for the Mag 7 versus the equal weight S&P 500 already this year.
Yeah.
What's the recipe for better breadth, improving breadth?
Well, I think it's partly the economy. I think the economy actually surprising somewhat to the upside, but also more that Goldilocks scenario where inflation stays, somewhat constrained and the 10-year stays below 430 or so. I think we go back above 430. I think that's going to be a risk to the overall market. We're having a lot of discussion this morning on some of the regional banks. I mean, that does show that these higher interest rates are biting in some areas of the market. I will say, though, I mean, if you think about since the October low that we saw, the S&P is up about 38%. Regional banks are down 21%. So the question becomes, how much does that matter for the overall market?
You talked about resurgent inflation, and I think we have to go there, especially given the ISM services data and the fact that we have gotten better than expected data again and again. How do you see that playing out? Does that hurt Mag 7 more than it hurts some of the smaller companies that haven't seen the same kind of boom?
Yeah, it's a good question and a curious one, because in some ways, given what we saw the last week or so, you say better economic data, better GDP, better ISM, that's good for corporate profitability, that should be good for small caps. But because of the interest rate sensitivity and the leverage that these companies still have, they're underperforming. So, I think the inflation is not going to be a straight line. I think it's going to inject the volatility. But I think this year's, one of our mottos is be prepared. This is not the time to be on autopilot. And I think there will be times that we can use this volatility as an opportunity on both the upside and the downside this year, especially with we have 40 elections as well. But I think the inflation is a risk that the economy is on a short-term basis, almost feels like it's reaccelerating a little bit. The PMIs have been low for so long, they can't really be down forever. Inventories are actually very low as well. So I think that's the risk, and that's why the Fed's pushed back. I think they have scar tissue from this inflation of the last couple of years, and I think it makes sense that they push back on the rate cuts.
So we haven't heard a lot of conviction from pretty much anyone this year. It seems like everyone comes out and they're saying, we'll have to wait and see. We'll look at the data. We'll try to figure out where things are. Can you take us on a tour kind of your view and how it's shifted over the first, say, 45 days of the year as you take a look out and say, OK, we're pricing in a soft landing. It still looks like a base case. Where do you push back? Where do you change your allocation?
Yeah, so we haven't changed our allocations. I will say it was somewhat surprising. We're still overweight the U.S. globally, and we're still overweight tech. I am surprised by how quickly that the Mag 7 has reasserted itself in the first month of the year. We had that big rally that brought in the last 2 months of the year, small caps up 25%. So I think that's somewhat surprising. We didn't make a shift yet. We basically, towards the October lows, we said these markets were so stretched that we thought there would be a bounce into year end. So at this point, I mean, I think the one thing that the economy is a bit stronger, we were already saying that we thought the Fed was going to only cut 3 or 4 cuts because of that scar tissue. So not a lot has changed, and we haven't made any significant asset allocation decisions yet. We're still waiting for more confirmation on a shift to the average stock. We're just not seeing it yet, and we're going to be a little bit late, but we want to see more of a sustainable turn.
In the meantime, people are taking a look at the data and saying, what data do we trust? And we keep hearing that again and again. The latest data coming out of Citigroup's Andrew Hollenhorst pushes against some of the headline data, talking about delinquencies now on credit cards surpassing pre-pandemic levels. You're seeing this in anecdotal data. How much do you trust some of the jobs figures, the other information that suggests things are reaccelerating?
Yeah, well, I mean, I think there's some challenges with some of the seasonality issues, but across the board, if you look at job openings, quit rates, initial jobless claims, even if we say that Friday's jobless employment number was 200,000 instead of 350 or 175, that's still very healthy and actually above trend as a whole. So I still say the economy we think there's going to be a step down in growth. The labor market should cool somewhat, but it's still relatively healthy from what we see at this point. But the main thing we're looking at too is obviously the weekly initial claims every week. We're looking at the credit markets. Those are things that we're seeing are we starting to see some cracks, even with some of the issues in commercial real estate? Are we seeing it manifest itself more broadly? We're not seeing it yet, but that's where we're attuned to at this point.
Keith, before you go, favourite sector right now, what is it?
Only one.
You got two?
I got three.
Give me three.
I'm going to give you three. Well, we still like tech, but I do think tech's going to consolidate here a bit.
Okay.
We like consumer discretionary, which is a mix of growth and kind of that cyclical play. And believe it or not, we do like financials, but we like the larger cap financials as well, based on the more resilient economy. So hopefully I can get one of the three right, so I can come back and say I was right.
Just on number three, which
Yes.
is what we'll follow up on, no doubt, in a few months' time when you come back.
Okay.
Number three, the financials.
Yep.
Do you think that this will be an isolated issue for a small number of small banks in this country?
If I say that and I'm wrong, you'll replay that in like 6 months.
Without a doubt, obviously.
So,
But I'm trying to find out how you're thinking about it right now.
At this point, I think the Fed, the Treasury are very attuned to this. They have a playbook on this as well. So I think it's going to hurt the economy. I think we're going to see a maturity wall that picks up this year hurt. But at this point, I think the larger banks are very well capitalized, and I think the regulators are on top of it. So at this point, it doesn't seem like this is going to be systemic. But again, you got to watch to see if this starts to manifest in credit markets. We're not seeing it as of yet.
You sound like Secretary Yellen, which may or may not be a good thing in 3 months' time. Keith, it's good to see you.
Great to see you all.
Thank you, sir. Keith Lerner there of Truist. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The troubles in the U.S. commercial property market, which have hit banks in New York and Japan, is spreading to Europe. German real estate financer Deutsche Pfandbriefbank has seen its bond slump on concerns about its exposure to the sector. The bank responded with an unscheduled statement saying it has increased provisions because of the sector's persistent weakness. Shares of New York Community Bank have reversed in the pre-market trade. They're now higher. The bank named Alessandro Dinello as executive chairman effective immediately. The CEO is pledging to bring in new executives after Moody's cut the bank's rating to junk yesterday. The bank has lost nearly half of its market cap in a week after hoarding cash and slashing its dividend. The bank took on assets from Signature Bank last year, including 2 risky loans and commercial real estate. Uber has delivered a beat on bookings in earnings this morning. December's quarter marks the 3rd consecutive period of operating profit as Uber looks to trim costs. Results for the ride-sharing company were also given a boost by growing demand in Latin America and the Asia-Pacific region. Plans to return more capital to shareholders will be announced last week. The Uber CEO, Dara Khosrowshahi, joins Bloomberg TV at 11 a.m. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Coming up next on this programme, a border deal that's dead on arrival.
It's been made pretty clear to us by the Speaker that it will not become law.
That conversation up next from New York. This is Bloomberg. One hour and 15 minutes away from the opening bout. Equity futures on the S&P 500 positive here by 0.25%. It yields higher by 2 basis points. The 10-year 412.30. Under surveillance this morning, a border deal that's dead on arrival.
We had a very robust discussion about whether or not this product could ever become law. And it's been made pretty clear to us by the Speaker that it will not become law.
It's the latest this morning. Senate Democrats refusing to give up on a bipartisan border deal that would unlock aid for Ukraine. Mounting GOP opposition is all but certain to sink the measure. Senator Rick Scott writing this: our lawless southern border poses a huge threat. The Schumer-McConnell-Biden deal still allows criminals and terrorists to continue to pour into our country. We need actual border security. Senator Scott, I'm pleased to say, joins us now for more. Senator, I'm just going to start the conversation by sharing 2 quotes with you, and you can help me understand who's got this right. The first quote is from House Majority Leader Steve Scalise, who says, here's what people pushing this deal aren't telling you. It accepts 5,000 illegal immigrants a day. The bill, as you know, sir, because you've read it, specifically refers to 5,000 encounters. Your colleague in the Senate, Senator Langford said this to Fox News: if you get to 5,000, which we have been there every single day except for 7 in the last 4 months, 7 days in the last 4 months, that it completely closes the border down. It deports everyone. Senator, why are Republicans struggling to get on the same page on this bill?
Well, the problem is this is not a border security bill. It's an immigration bill. When you go back home to my state of Florida, what people want is they want a border to be secured. Chris Murphy, who is the Democrat leading the negotiations on the Democrat side, said the border will never be closed. So when you hit that 5,000, all that has to happen is all those individuals get shipped to a port of entry, and they can still come through. So it's not, unfortunately, it's not a border security bill. It's an immigration bill, and that's why it's not going to happen. It was, unfortunately, just they did it behind closed doors. They didn't ask for people's input. They sprung it on us Sunday night, and it's not something that we want to do. We don't want an immigration bill. We want a border security bill. That's why it's not going to pass today.
Senator, how are you left behind in negotiations, though? In December, in the Wall Street Journal, you, along with your colleagues like Mike Lee, were quoted as saying one of the proposals is that this would reduce illegal crossings, and that number of illegal crossings reduced by about 20,000 from the prior month's level. That's what you were looking for, those reductions of those crossings. And you said, quote, we've been told that that's part of the conversation. So you've known about some of these conversations from December. Why are you shocked now?
Oh, I'm not shocked. It was clear, Mitch McConnell made the decision that we would not hold a lawless Biden administration to secure the border. The only way we could do that is say, we will not give you Ukraine aid on a monthly basis unless the number of people crossing the border and staying here comes down. So I've always had a concern about the bill. There's a lot of other concerns about the bill, but my biggest concern never was addressed. We have a lawless administration that could secure the border today. Trump secured it with the existing law, and there's nothing in here that would make Biden secure the border today. And then Chris Murphy said, he was clear, the border will never be closed.
Does this bill, what you see, and you've read through the 300 pages, weaken any immigration law we currently have?
Well, I think a lot of concerns is that it will prevent a Republican president that does want to secure the border because it'll have some limitations on their ability to actually close the border, which the president has the ability to close the border today. So there's a lot of concern that through the court system, that people that want a completely open border, like Joe Biden does, will be able to go to the courts and forever keep the border open. As Chris Murphy said, the border will never be closed. That was their plan. So here's the problem. James Langford is a good person, tried hard, knows the issue, but he was negotiating with somebody that didn't want to have a secure border. And he was hamstrung by Mitch McConnell, who said, we're not going to tie Biden's hands to force him to secure the border today. That's what Floridians want. They want a secure border today.
Biden says that he would close the border if this bill became law. So why not put it in his hands and see if he does it?
He could do it today. He hasn't done it today. The day he came into office, he implemented catch and release. He stopped Remain in Mexico. He stopped building the wall. He sold off the steel. So, look, Biden doesn't want to have a secure border. You're going to trust somebody that has shown you through their actions for 3 years they don't want to have a secure border? He doesn't need another bill. The only way this is going to happen is we get a president that wants to secure the border. He could do it today. He's made the decision, Biden, to not have a secure border.
Senator, I have to say, just taking a step back, there's just a lot of feeling that there's just utter dysfunction and nobody wants to negotiate with anyone because it's political season. And it makes Biden maybe have a win rather than the former President Trump who's running on this issue. How do you push back against that when it seems like some people are rejecting the bill before even reading it?
Well, I told him my concern was we got to make Biden enforce the law, and that was my concern all along. There's a lot of provisions in here that make this an immigration bill, but look, we should be doing up here is we should be having robust conversations on the Senate floor. All people, everybody there, bring your ideas, but that's not how this is done. What we've been doing, I've been up here 5 years. Schumer McConnell negotiated a deal behind the scenes. They showed it at the last minute and expect to vote. They gave us this bill Sunday night. We've not seen any text before and expected us to vote on it today. That's not the way this should happen.
Senator, I understand you don't like the way this process went done, but when you look at, say the Border Patrol Union, they endorse former President Trump. They say this is better than nothing. You look at the numbers in December, more than 300,000 migrants along the southwest border. That's nearly 10,000 a day. I've read the text, and it says if this deal was in place in December, 5,000 encounters, the border automatically shuts. At that, if you look at those numbers, at minimum then, this would be cutting December in half. How is that not better than what you have today?
Well, it doesn't say the border closes. What it says is you have to go to a port of entry. So the border does not close. So here, why don't we go back and secure the border with the existing law? I mean, we have a lawless president. It doesn't matter what bill we pass; he's not going to enforce it. So why doesn't Joe Biden do his job? He's the president of the United States. His responsibility is to secure the border. We've got 70,000 people dying of drug overdose. We've got terrorists. We got human traffickers. We got criminals coming across the border. Why doesn't he do his job? That's what the expectation should be. Is we have a president that does the job.
You have a Democratic president. You have a Democratic-held Senate. The Republicans control one half of one branch of government. Why is this not an incremental step that you can build on? It is a divided government. You're going to need Senator Chris Murphy to bring his Democrats along.
Well, I mean, why don't we have a secure border? I mean, we have a lawless administration. I'm not going to say, oh, I'm okay with 50 terrorists coming into my neighborhood. I don't want that. I think we ought to have a secure border. I don't want drugs coming to my neighborhood. I don't want terrorists. I don't want human traffickers. I don't want any of this stuff in my neighborhood. We should expect our government to do their job, secure the border. This will not secure the border. We don't have a president that's willing to do it. There's nothing in this bill that's going to force him to secure the border.
President Trump has been very public that he does not want to see this bill go through. Do you speak to him regularly?
I do.
And is your sense that this is the top issue he wants to run on, and that is why it's become politicized in Washington, D.C.?
He's not talked to me about it. He's not asked me not to support it. I've been clear all along. I want a secure border. We've been having the same conversation for months. I will support a bill that has a secure border. All right. But we have to remember the only way that's going to happen is we have something in here that forces Biden to do his job. He could secure the border today. He is elected not to secure the border.
Senator, it's fantastic to catch up with you, sir. I have no doubt we'll be continuing this conversation in the weeks and months to come. Thank you for joining us today. Senator Rick Scott there on the latest situation down in Washington, D.C. That does not sound like that bill is going to see the light of day anytime soon.
No, but in the future, it could potentially work as a framework for where you see both sides of the aisle are. The issue is this is a divided government. Republicans have control of one part of Congress. And even though they had to deliver Mayorkas yesterday, Israel, they didn't deliver any of these. They were pitching this to their base. So this becomes a big problem when even the Republicans holding a majority of one part of the government can't get through some of their bills.
Regardless of what you think about the substance of this bill, and we could talk about it all day, we're not going to. Ultimately, at the moment, this is going to be and is a massive campaign issue for the election in 2024. And if you want to get into the blame game, the polling is pretty clear. It's not about what I think about it, you think about it, any of us think about it. It's not about what the senator thinks about it either. In the court of public opinion right now, they're blaming the executive branch, they're blaming the White House, they're blaming the president. Now, if you don't deal with the bill that's on the table right now, does the polling change anytime soon? Does it start to move against the Republicans and away from the White House? At the moment, it doesn't look like that at all.
Yeah, but President Biden talking about it yesterday and trying to basically put it out there, saying we gave them a bill, we gave them what they wanted, and they rejected it. The problem that I have is there doesn't seem to be an honest discussion about even what the facts are out there. And I think that when we start questioning what the facts are and people are disagreeing on that, it's hard to have any kind of intellectual debate.
Most experts are saying that this 5,000 encounters and an automatic shutdown on the border is very similar to Title 42, which Republicans loved under the Trump administration. So I think, John, starting that conversation, talking about what Steve Scalise is saying, then what Lankford's saying in the Senate, was a good way. The Republicans are not actually agreeing on the facts.
They're not on the same page at all. on the issue right now, and you can see that based on the communication over the last week or so. Coming up on the programme, up next, Nationwide Chief Economist Kathy Bostjancic. You're watching Bloomberg Surveillance with your equity market positive 0.25% from New York. This is Bloomberg. We are 60 minutes away from the opening bell. Stocks are higher by 1/3% on the S&P 500, up by almost 0.5% on the Nasdaq, positive by 0.3 on the Russell. The small caps doing okay this morning. In the bond market, 2-year, 10-year, 30-year, for those of you that missed it, 5 times a little bit earlier. We talked about supply. We'll do it again. Coming up later, $42 billion of 10-year notes. After that tomorrow, $25 billion of 30-year bonds. That's a lot of supply, Lisa, going into a bond market that's repriced yields higher over the last week. Up another basis point this morning, 411.53 on a 10-year, on a 2-year, 441.83.
Our regular viewers have heard me talk about auctions too much, so I'm going to channel somebody else. Michael Kudzel, portfolio manager over at PIMCO, saying the auction will certainly get absorbed, so that's perhaps a news killer. Supply can tell a story that matters at any given moment, but bigger picture, if you look at just what supply has meant for yields, it hasn't meant very much. And that basically is just the story, that basically we can paint a story and sound sensational about it. Record auction, wow, so much debt, so much interest, dozens unsustainable, and it will all get absorbed.
This is quite a mood this morning that you're running with. Quite a mood. I thought you were into supply.
I am into supply, but it's just a frustrating story because I'm into it over the longer term, and it can shatter market sentiment. But the problem is that some of the logical connections don't work when it comes to the market reality.
And that's frustrating.
It has been frustrating, yes.
I get it, OK. Yields are up now, basis point, 411.34. I mean, you sound really frustrated about this issue. In foreign exchange, the euro, 107.82, just about positive, stronger there by, let's call it 0.25%, positive by 0.26% on the euro against the dollar. Under surveillance this morning, House Speaker Mike Johnson suffering 2 setbacks just moments apart. Republicans failing to impeach Homeland Security Secretary Alejandro Mayorkas yesterday by a vote of 214 to 216. Speaker Johnson vowing to bring back articles of impeachment against Secretary Mayorkas in the coming days. Just moments later, a standalone bill providing aid to Israel without funding for Ukraine also failed, raising questions here, MH, as to why this bill was even put out there to vote.
If you knew that it was going to fail. Well, that's why Punchbowl this morning is calling this embarrassing. You put bills on the floor and you know they're going to fail, and you have the majority. It's concerning.
And the bill is coming back.
And yes, and that is why Politico this morning says that the biggest factor tamping down talk about another motion to vacate for this new speaker could be the fact that they don't really have anyone else. But if he has any more days like yesterday, that might change fast. What's going on? You have the majority, and you cannot get even sometimes simple rules through.
I'm not even going to turn to Lisa to get any thoughts on procedural issues down in Washington because her head might explode. So let's talk about this instead. You hate that story.
I do hate it. Do you like it?
No, I hate it too.
Okay.
New York Community Bank rising this morning.
There for me.
Some better news. The company is saying the following. Deposits have climbed since the end of last year and liquidity remains ample. The bank also announcing the appointment of a new executive chairman. Shares had fallen to the lowest level since 1997, while Moody's cut its credit grade to junk. The ratings agency citing multifaceted financial risks and saying it could slash the regional lenders' rating further if conditions deteriorate. We have been absolutely hammered over the last week or so, 7 days and down 60% on that name.
And dragging down other small banks as well. I do have to say, this really is notable to me that it really has been viewed as a larger issue, and not necessarily in terms of some sort of collapse that would trigger rate cuts, which might be a positive thing for the overall market, but rather as just sort of this headwind to growth, headwind to credit creation, as Mike Wilson was talking about, and a headwind to this idea that we're going to see rates bite. It just might not happen on the scale that some people are talking about.
You've got to separate two issues, which is what you're doing, systemic risk and just a massive headwind to profitability, and tempering their ability to finance the economy. Could lead to tighter lending standards, less financing all round for the small and medium-sized lenders. I think that's the ultimate concern here. I don't think it has to be the doom, gloom scenario of, say, last spring, where everyone's worrying about the overall health of the financial system. With that all being said, this has been a part of the market we've been focused on now for 18 months. Commercial real estate will hurt some lenders more than others, and we know it feels like a perfect storm. We've talked about low vacancy rates, higher interest rates, the fact that people aren't coming back to the office, and the fact that these loans are all maturing, some of them at the same time. it's like right here, right now this year.
To take it a step further, exactly to your point, because it's not going to become a systemic failure, it's not going to trigger the same kind of policy response that previous systemic failures have. You're not going to get the bailout in the same kind of way. You will let banks fail. You will let some of the consolidation happen. You will let this company get downgraded to junk with more than $100 billion of assets. And that, I think, is the difference that people are trying to grapple with. What is the broader market implication of that there isn't that relief valve in the same way?
Watch this space, and we'll see how it develops. Let's finish on the Fed. The Fed Speak parade continues. Cleveland Fed President Loretta Mester saying policymakers will likely gain confidence to cut quote later this year, adding it would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. The Minneapolis Fed President Neil Kashkari saying, quote, we're not all the way there yet. Collins, Barkin, Bauman on deck a little bit later today. Kathy Bostjancic, chief economist at Nationwide, joins us now for more. So, Kathy, we've had some pushback over the last week from Chairman Powell and others too, and the data has reinforced that. Payrolls on Friday really strong. ISM services this week, Monday, was just tremendous, and throw in prices paid picking up as well. Kathy, have you changed your view, your base case on that first move from this Fed?
Hey, John, good morning. Well, it does seem like it's lining up that you're going to get a later move from the Fed. We had been looking for a move, a rate cut in May, but said June was possible. And it does look like it's lining up to be either May or June. And, you know, I think they're in an interesting position here, right? Because I think what Chairman Powell told us was that a strong labor market, strong economy wouldn't preclude them from cutting rates. And I think that's still the case. But as you said, we're actually seeing some signs of a reacceleration in economic activity. So we need more data. I guess we're in the same camp as the Federal Reserve. We need to see more data before we can decide, you know, when exactly they're likely to cut rates and by how much. I think that matters as well.
So, Kathy, at the moment, you were still looking for that soft landing, or rather that mild recession developing mid-year. Kathy, can you tell us on your dashboard right now, what's guiding that call ultimately for you that leads to a mild recession in the middle of the year? Because the data we're looking at, just at the surface level, really strong labour market report, really powerful ISM services, manufacturing actually picking up and getting closer to expansion. What's guiding your call?
Yeah, no, you know, there's definitely upside potential for our call here, and the recent data do give us some pause. You know, before we got the blockbuster and surprising number on Friday for payrolls, we actually had seen a slowing in the cyclical sectors, right? So outside of government, healthcare, and education, which in the prior months had accounted for almost, you know, over 80% of the job gains. So that meant the cyclical sectors were seeing a slowdown in employment. Friday's number changed that, right? Not only did we get that strong January number, but we got the upper revision to December. Where we were scratching our heads a little bit, and why we haven't yet thrown in the towel, is that we see the work week continue to decline. And that just stands out as an aberration to everything else, but maybe it's a warning sign. Again, I think we need a little more data to be really confident ourselves that, you know, we're going to avoid this recession. The other thing is the pop in average hourly earnings standed out in a very odd way as well. And maybe there's some seasonal problems, right, with the data. We know December, January, there's a lot of seasonal adjustment factors. And the fact that the work week fell, it artificially could push up average hourly earnings. So just more clarity. The one thing I would also add is we've been watching the consumer. And what I find really striking is that the unemployment rate being low at 3.7%, yet we're seeing an increase in delinquency for payments of credit cards to a degree that's consistent with recessionary conditions. So if things are so good for the consumer and the labor market, you know, why are we seeing that? And to me and to our team, it really shows that consumers overextended themselves. And at some point, we need to see consumer spending rein in.
This is something that I know Andrew Hollenhorst also pointed to in a report this morning, that credit card delinquency data. I am wondering if it's normal, if you can point to another time when we've had this sort of no man's land, this lack of clarity, this conflicting data that people parse through and tell the story they want to tell. Is there any analog to this?
You know, each business cycle is unique. This one is extremely unique because of the pandemic. So, you know, there is a degree of the rebound in usage of credit card that we saw, I would say, through the halfway point of last year, which just was getting back to kind of trend, right? When we couldn't travel, couldn't dine out, credit card usage plummeted. And then it's come back. Consumers started to embrace credit, and that is all good. And I think it was healthy to a degree. But then when we saw the pandemic savings be, almost fully depleted, 2.1 trillion, you see the savings rate fall, to 3% handle, and that's less than half of what we saw pre-pandemic. And then you see this increase in delinquencies. To me, that's a consumer who's run too hot and has to pare things back. Unless somehow we get an increase in supply of labor and we could continue to churn out these really strong labor numbers. That's why I think we need a little bit more clarity to see how this plays out.
As you're talking, I'm just thinking about John's question to so many different people, which is how does buy now, pay later change some of the data and sort of change the landscape in terms of understanding the consumer? Does that factor in that some of this debt isn't really even materializing in the same kind of traditional ways because the ways that people are paying for things has shifted so much?
That's a great point. We did see the consumer, and we'll get consumer credit, I think either today or in the next day or so. We'll get the latest consumer credit numbers. What we saw in December is that it picked up quite sharply, and the prior months had been trending lower. So what we know is probably that buy now, pay later was used pretty extensively during the holiday season. Now that's okay if when the bill comes due, you pay it off in full. But we suspect that that's not the case, especially for younger people. We see a reliance on that. And when you see those delinquency numbers, no one really wants to be more than 90 days late on their credit cards, right? The interest rate penalty is so high. So to me, it just shows us a consumer that is strained. And unless, let's put it this way, the consumer is not prepared for a slowdown in the labor market. That's where we're concerned.
Kathy, great to get your thoughts, an update on them after the data we've seen over the last week. Kathy Bostjanschit there of Nationwide. Let's get NYCB up on the screen. Check out the share price. Alessandra Dinello named as the exec chair a little bit earlier on this morning. The stock positive now by 1.2%. Speaking on a call in the last few minutes, giving you a little bit of an update on what's happening with the bank on the ground, just the inner workings of it, saying it has a strong liquidity and deposit base, virtually no deposit outflows from retail branches. I'll repeat that, virtually no deposit outflow from retail branches. Going on to say, focused on doing whatever it takes to build capital. If we need to shrink, sell assets, we will. We will reduce commercial real estate concentration, Lisa, as quickly as we can.
And what you can see is the shares losing that gain that they had earlier, now up just 1.4%, including the potential for what she's now saying is loan sales as one of the options. The question I have is, if you get forced selling, when do you start getting a real-time pricing of a property that has otherwise been highly illiquid and not really market priced?
That stock is up by about 1.4%. I think, to your point, there's always been this feeling that it's art, not science, when it comes to the pricing of some of these assets.
100%. A lot of these assets have mark-to-market prices that don't reflect a market that is not currently happening. Here's a key question. She tried saying that deposits are steady and saying we haven't seen any outflows. That hasn't moved the needle. What people are looking at is for forced sales in commercial real estate, and that, I think, is what's going to get people's attention.
Credit risk, just a final headline for you, really curtailed commercial real estate origination in recent months. The communication from the bank there just a moment ago. Any more headlines there, we'll bring them to you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. U.S. investigators confirmed that the Boeing jet involved in last month's Alaska Air incident was missing bolts on its door panel. Photos and other evidence from the report suggest that 4 bolts were removed at Boeing's factory in Washington and were never replaced. The full investigation into the incident remains ongoing and could take a year or longer to reach a conclusion. Boeing said it will review the report and continue to cooperate with U.S. investigators. Ford shares continue to gain after beating on earnings and boosting its outlook yesterday. The automaker is also the latest to lower expectations for electric vehicles. CFO John Lawler told analysts the company no longer expects to hit an 8% margin on EVs in the coming years. Instead, Lawler pointed to growing demand for hybrids, expecting sales to grow 40% this year. That's a jump from 25% in 2023. Nearly 68 million Americans are expected to place a bet on this year's Super Bowl. That's according to the Gambling Industry's National Trade Association. It's a 35% jump from last year, with the total value of bets placed to estimate surpassing $23 billion. But of that, just $1.5 billion is projected to be bet with legal outlets. Sunday's Super Bowl pits the Kansas City Chiefs against the San Francisco 49ers. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Just want to squeeze in this story from Tesla. Dana Ho and Ed Ludlow, our colleagues, writing this one up. Tesla staff bracing for potential job cuts after managers were asked to affirm whether each of their employees' positions are critical. According to our reporting, US managers had to make the binary assessment of their deputies' roles in recent days. Tesla sent out the single-line query for each job after cancelling some employees' biannual performance reviews, according to the people behind this reporting. Lisa, the stock is higher by 2.5%.
Is this from the playbook of McKinsey? How do you build staff morale? I mean, seriously, if you wonder how people would feel if you say, is your job critical? Can you justify it?
A Tesla issue or sector issue? My first question, really.
It's a great question. We just saw Ford, though, outperform with respect to their earnings. GM, the same thing. Maybe it's in terms of expectations that Tesla was something other than a car company, beating the reality of being a car manufacturer.
The latest reporting from our colleagues this morning, as again, I say, the stock is up by 2.7% in the pre-market. Up next on this programme, we're going back to the bundle.
Another core building opportunity is taking ESPN, which is already the world's leading sports brand, and turning it into the preeminent digital sports platform.
Taking a step towards that conversation, up next. Live from New York City, counting you down to the opening bell, 42 minutes away. Equities doing okay. Session highs, actually, up 1/3% on the S&P. Yields up a single basis point, up 1 basis point to 411.34. Under surveillance this morning, we're going back to the bundle.
Another core building opportunity is taking ESPN, which is already the world's leading sports brand, and turning it into the preeminent digital sports platform. We're already moving quickly down this path, and we are exploring strategic partnerships to help advance our efforts through marketing, technology, distribution, and additional content.
And they are doing just that in the last 24 hours. Here's the latest this morning. Disney, Fox, Warner Brothers Discovery teaming up to launch a new sports streaming service here in the United States. The joint venture would include professional and college sports and is expected to roll out this fall. A name and price have yet to be announced. Michael Nathanson, senior research analyst at Moffett-Nathanson, predicted much of this, and he joins us now. Michael, it's good to catch up with you, sir. You were looking for this to take place. Any surprises for you at all overnight?
I'm surprised it actually happened because it's logical, but it puts these guys in conflict with a lot of their distributors and their own businesses, but it has to be done, right? The bundle has to shrink down to sports. It makes perfect sense.
So, Mike, can you tell me now, and this is kind of a separate story, what this is going to mean for the next sale of sports TV rights in the next few years?
Yeah, it should dampen demand because, in theory, these companies don't have to compete with each other. You would think they basically have one product. And rather than, let's say, Fox and ESPN challenging each other for college football playoff rights, they can work together. Maybe they won't be bidding blind for those rights. So those rights, we've done a lot of work in our firm. We think we've hit a top in sports rights values, and this is just going to accelerate that change, right? You saw a couple weeks ago that the wrestling rights, WWE rights, left Fox to Netflix in a global deal, and that was a good deal for Netflix. So that was a sign of the change that was going to come.
So, Michael, can you walk us through some of the financials? If you think that we've seen the peak in terms of valuation of some of these rights, what should a bundle like this cost, and how can you view the partnerships with other potential streaming services?
Okay, so that's a key question, right? We don't have a number yet of what the price should cost. I would note, though, that the companies involved have left off very important assets in their network bundle. So Fox doesn't have Fox News here. Warner's has dropped a ton of networks from Discovery and Turner. And ESPN and Disney has dropped all their non-ESPN networks. So to begin with, they really dropped a lot of expensive networks. We're waiting to see what happens on price. But in terms of the financials, I think this is going to start off as a break-even business at best, right? The idea here is to offer customers something to stop them from cutting the cord and maybe stop them from going to YouTube TV, which announced 8 million customers yesterday. So I see this as, what we've done over the years, we've done a lot of research on consumer behavior. Something below $40, $45, that's a really important price point, and that'll get people's attention. Then the issue is, Lisa, is that you have to then add Paramount Plus and Peacock to get the rest of the sports that you want. And those products could be $5 a month. So I'm looking at this as probably sub $50 a month, which is a $30 savings versus the lower end bundles in streaming right now.
Michael, who is sports supporting? Where if sports goes away, those streaming networks no longer can stand alone.
Well, sports has been preserving the economics of long-tail cable networks that really didn't have much of a calling, right? So if you look at everyone who built their business, they would lead with sports and they would add 20 channels behind that, right? Paramount has a slew of channels, but CBS drives the lead there. So I think when you start unbundling sports networks, it's going to put a real pressure on non-news, non-sports businesses, right? So, our firm's call have been consistent over the years, which is we don't want to own cable networks that are not tied to sports and news, right? So, but I give Warner's credit because they made a tough decision to not carry a lot of their networks in agreeing here. So to me, I think it's going to hurt, the Paramounts of the world, the NBCUs, and even the Warner Brothers in terms of their network portfolios over time. But it has to be done. The bundle has to get smaller.
So, Michael, I've got Hulu already. I'll be able to access this, right? Nothing changes for me.
No, you're gonna have a decision, John. Do you want to drop Hulu and take this package?
Is that what I've got to decide now?
Yes, you will. And you have to decide, do I cobble together this package by adding Peacock and Paramount to your sports bundle, right?
My goodness.
So, yeah, I know. It's the issue is that, as we said this a couple weeks ago, the industry is not aligned with their strategies, right? You have this fragmentation of strategies. Peacock and Paramount have done something differently than these other three companies. At some point, the world's got to come together and agree that a sports-led bundle at a certain price is the right way to go for everyone, right? Right now, you've got two outsiders who don't agree to that.
It just feels like the consumer loses every time. Michael, I'm wondering now whether the sports content providers, NBA, NFL, Premier League in the UK, they just go their own way now and have their own streaming platform instead of trying to sell it directly to consumers through these guys.
I think there's too much risk, right? If you look at the revenues generated by these companies and affiliate fees, there's still such a large amount of, their checks are still too large if I'm a team owner to take the risk to go it alone. What we've learned, John, over the years is that streaming is a really hard business. As we talked about, it's at this point, except for Netflix, it's a no profit business. Yeah. So I'm not sure the leagues want to take that risk. If the checks are still being cut by Disney, Fox, and Warner's, we'll take those checks as long as we can.
Michael, I wanted to finish on this, just with regards to this topic. You remember Hulu was a joint venture. Disney took the whole thing over eventually. I wonder if this turns out to be like a reverse Hulu for Disney, that ultimately this becomes the vehicle to spin off ESPN.
It's a good question. I think there's probably an intermediate step where you probably need more consolidation amongst the network owners. It's a good question. I think Disney, I can't answer it because I would think if you're Disney, there's value to your question about having Disney tied to the rest of ESPN tied to the rest of Disney, right?
Right.
So that is a big cut because Disney has used sports to drive value elsewhere in the enterprise. I don't think that leads to essentially Disney being spun, but probably more M&A within the sector. So I think your question's a great one, but probably 3 or 4 years down the line, I don't think this delivers Disney to spin out ESPN on this news.
Disney reports after the market a little bit later. It feels ridiculous to talk about them after the fact that Meta added a Disney in terms of market cap on Friday. And you and I need to talk about Meta in the next couple of weeks, so let's do that. Michael Nathanson of MoffettNathanson there. He's had a buy on Meta, I think, since the summer of 2019. Just stuck with it. It's really picked up recently.
He's been absolutely right. He's crushed it on that one. I do wonder, though, you talk about the consumer losing. Jim McKelvey had one of the most interesting ideas, I thought, about AI going out, finding what you want to watch, charging you whatever rate that is, and that's people, that's sort of the future of how this content should be delivered.
Final thoughts this morning?
I would just say there is a feeling of frustration in the market with me.
It's not personal.
Just because it feels like we're talking about a lot of the same stories and not making progress on them. And that's frustrating because it's whether it's the economic data that's uncertain or whether it's some of the congressional issues.
I was going to say, there's the same frustrations of a lot of the same stories that are not having endings happening in Washington, D.C. Also, public service announcement. President Biden is in New York City today, so be careful on the traffic.
There we go. Get home quickly, I think is the message there. Tomorrow, Richmond Fed President Tom Barkin, Disney CFO, Hugh Johnston, George Saravelos of Deutsche Bank, and Christina Company of Invesco. A lot more still to come tomorrow morning.